the policy reaction function in China. And that's critical if you are an investor, let alone a foreign investor. So he's going to need a lot more than words, John.
This was the charm offensive, TK, we expected.
Yeah,
this was it, but to Mohammed's point, it's not sufficient.
Yeah, to me, the arc into not only 2024, but 25. Dr. Valerian, would you suggest that the critical point for them is to bring some form of capitalistic structure back to Hong Kong? I mean, they trashed Hong Kong. Do they need to bring it back?
I think it's way beyond that. I think they need to evolve their growth model. They need to stop pulling everything up to the top, push it back down, let the bottom-up forces act, and critically understand they need to transition to a consumer-led economy. This is hard, but you will hear people say without that, they'll get stuck in the middle-income trap.
And we have talked about a consumer-led economy since Jonathan Spence was a young man. It hasn't happened, has it?
No, because part of a consumer-led economy is to give up control, and that's the hesitancy. So they have to evolve this, and they're scared about two things. They're scared, one, of losing control, and two, they're afraid that this will come with some type of corruption. So that's why they're going slow. So they'll talk about high-quality growth, but they're not actually putting in place what's needed for high-quality growth.
These are huge challenges. Just before we get to our next guest, I want to squeeze in this story. All the hype around the Las Vegas Grand Prix for Formula One. Here's the drama. Tempers flaring after organisers cancelled the first practice session after just 9 minutes when Ferrari's Carlos Sainz badly damaged his car driving over a loose manhole cover. Ferrari team principal Frederic Vasseur saying, quote, "We had a very tough FP1 that is going to cost us a fortune. It's unacceptable." Toto Wolff of Mercedes, who we caught up earlier this week. Tom, we've talked about this time and time again. Is Formula One sacrificing the integrity of the sport, chasing commercial objectives in the United States of America? Listen to Toto Wolff. They're going to seal the drain covers and nobody's going to talk about it tomorrow morning. Well, hello, we're talking about it. It's completely ridiculous. You're speaking about a drain cover that's been undone. This has happened before. That's nothing. Tom, it has happened before. It has happened before, back in Azerbaijan several years ago. But ultimately, this is what we feared all year. You chase this commercial gain, you go to places like Las Vegas, and you end up in situations like this one.
I'm going to say this, and it's not nice, and I'm probably inappropriate, but the risk is there. I'm watching this on TV right now. Alonso just missed turn 12. Other people have missed turn 12. This course is brand new, and for the safety of the drivers, that's not good.
I think we all wish it the best of luck over the weekend.
Yes.
We hope it's a successful run of things over in Las Vegas, but certainly, TK, big challenges.
We will see, and we will continue here on what we do: equities, finance, investment, international relations, bringing all that together at Pamir Gordon, Simon French. Beautiful essays from their chief economist. Simon, what are you going to write about into the weekend, into Monday? We've got deflation out there, we've got weaker demand, we've got different dynamics, and I got a stock market to the moon. How do you synthesize that together?
So I was listening to your conversation about 5 minutes ago, the idea that US 10-year treasuries are trading like a penny stock, but there's parallels, aren't there, with that and the Magnificent Seven and the story in equity markets, and how do you pull those two together? I think we're seeing huge pro-cyclicality in pricing in capital markets, not just equity markets, but bond markets as well. And I think it's perhaps not a sort of short-term trading idea or a point of near-term directional impulse, but for the financial stability point, the health of our capital markets, allocative efficiency, the type of, if you like, the social good the capital markets do, is it a good idea that your cornerstone pricing asset in the treasury market and such a sinkhole for equity capital is behaving like that? I don't think it is, and I wonder whether regulators want to, given all the other challenges on their plate, get into a debate of decomposing why these big asset classes are trading like that in terms of what that does for financial stability, economic growth, allocative efficiency.
A broader question then, Simon French, as you write of often, can the capitalists get on the same page as the people in 2024, particularly after what we witnessed in San Francisco? They seem to be a bit removed.
Look, the social license of capital markets is very, very important, and I think, look, there's been quite a lot of, particularly in the United States economy post-pandemic, some quite encouraging redistribution, some reduction in those in poverty levels, but that's largely been the response of fiscal policy post-pandemic. And again, sort of taking it back from the near-term call to what we've learned about a response to a big economic contraction and the nature of fiscal transfers and what that does to growth and redistribution. I think there's now a really big divergence emerging from the experience of the European economies and the US economy that I think will frame responses to financial contractions, economic contractions for years to come.
Simon, imagine a regulator calling you after this interview and saying, I totally agree with you. The volatility in the bond market risks financial stability. Tell us, Simon, why has it happened and what can we do about it? What would you say?
Well, I think regulators for a long time, and this is a bipartisan comment, it isn't aimed at any particular regulator, have taken quite a consumer-centric approach to how the ultimate end investor allocates their capital. It's a reduction in fees, it's a preference towards passive allocation, which generates, in my views, more pro-cyclical pricing and heightens financial stability. So we have to, I think my response back to the regulators said, this isn't a free lunch. Yes, you are undoubtedly generating more consumer surplus for the end saver, but are you potentially introducing more financial stability risk? Yes, you are. Are you happy with that trade? If you're not, you need to vocalize what you're going to do about it, because ultimately that redistribution of the consumer surplus is the way to lean into it.
Okay, so I continue with you, Simon, and say, oh, you're just a worrier. Just look at the amount of volatility we've had and nothing has broken. The system is resilient. What would you say?
I'd say to say that nothing has broken, given some of the turbulence we've seen in terms of money market funds, earlier in the year, the sort of banking system being really stretched and stressed in the US economy. There are signs aplenty that this isn't a healthy backdrop. Now, the fact that we've averted through the relatively rapid response from both the corporate sector and regulators, that doesn't mean that the risks have gone away. Maybe we've been lucky, but how long do you want to stay lucky? I think we need to be ahead of these debates rather than constantly being reactive to these events.
Simon, appreciate that response. Thank you, sir. Simon French there, Panmure Gordon out of London. Simon's right, Mohammed, surely things did break. Some big banks went under this year. I know we moved away from that pretty quickly. It was back in spring, which feels like a lifetime ago, but things broke, didn't they?
But they broke in a very contained fashion. I think the big issue that we don't talk is that we changed the system in an emergency. We have indeed extended deposit insurance to all banks, to all deposits.
Let me get up and give a lecture here. This is from Queen College in Cambridge. I'm a visiting lecturer today. This was nothing more than a bailout of the fancy people. The banks that went under were nothing more than marketing concepts for the haves, the rich people, the rich guys, and we use the institutional insurance. I would love Spence on this. The institutional structure to bail out the rich guys.
But once you bail out the rich guys, you've got to bail out everybody. And that's how we've changed deposit insurance.
Right.
That's been a story of this year. 440 on a 10-year coming up. Stephen Shork of the Shork Group. Not on the surprises in the bond market, but on the surprises in commodities, with crude at 73.93 on WTI from New York City. Good morning.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Access Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
A lot of the inflation impulse on the way up was from higher oil prices. Oil prices have come back down. Commodity prices are under pressure. But if we imagine a scenario where China actually gradually comes back to strong growth, the U.S. stays resilient, I think we're going to have to be a little bit higher for a little bit longer.
Maybe a little bit longer, higher for longer. Bill Winters there, Standard Chartered CEO, speaking with our very own Haslinda Amin at the Singapore FinTech Festival. If you are just joining us, welcome to the program. Equity futures on the S&P 500 looking a little something like this, positive again by close to 0.2%. 3 days of gains could help us get to 3 weeks of gains on the S&P 500. Yields are lower by 3 basis points on a 10-year. We had a brief break of 440, back above it right now at 440.82. We're going to talk about crude in just a moment at about 74 on WTI. Let's get to one name in the pre-market, shares of Manchester United. A report from Sky News dropping in the last hour that finally, because I feel like I've been talking about this for ages, that Sir Jim Ratcliffe's Ineos Sports could announce a deal to buy 25% of the club for about $33 a share early next week. TK.
I look at it as an amateur. I mean, you guys are
On the bench for the last game.
Yeah.
He's not been playing well at all.
Who's he got to play with?
That's the problem.
Yeah.
They've been spending a lot of money as well.
I mean,
the Glazers have taken a lot of criticism for how they've run the club, and I understand that criticism and where it comes from. But ultimately, they've spent a lot of money on players, Tom, that just haven't got it done. That club just looks rotten on the pitch and off the pitch.
Why buy 30%? You don't get control.
It sounds to me, Mohammed, that they didn't want to sell the club to the Qataris, that the Glazers still wanted to retain a big stake in all of this. I do wonder what Jim Ratcliffe can do, whether he has a big say in all of this, Mohammed, on just the sporting side of the business in a way that maybe the Glazers haven't.
I'm going to point out right now, one of the highlights for Bloomberg surveillance this year worldwide, picked up like no other interview we've ever done. John Farrell with the gentleman from the Tots. That was really fascinating.
Daniel Levy of Tottenham.
In real time.
Yeah.
I just got to get this in right now. Now, we got qualies. Alonso out at turn 12. The Ferrari doing quite well in P2. Qualies 3 a.m. here in Las Vegas.
I'm sorry, it's ridiculous.
Qualies in Rome as well.
Okay.
And the uproar in Rome is that the North Macedonians are not showing up as tourists this time.
It's
Tension now.
qualifying for the Euros and Italy once again.
Is this the second game?
They need to know this is the group stage. They've got 2 games left, and they need to beat North Macedonia.
So if North Macedonia, it would never happen, but if they were to defeat Italy, it's one and done?
We'd be 3 points behind Ukraine, I believe, and we're playing Ukraine.
Can you remind the audience why this is so painful for you?
Oh, thanks, guys. Appreciate this. I thought it was between friends. North Macedonia kicked us out of World Cup qualifying not too long ago. Okay? All right? Do you want me to carry on working here?
Oil, let's carry on right
walking
now.
away.
Well, it's just suspect to say the least. Stephen Short,
Brutal.
principal of the Short Group, saves us now on oil disinflation. Stephen, how does New York Harbor adjust to oil deflation? All the little itty-bitty things, jet fuel, diesel, distillate, how do they adjust to this collapse in oil?
Yeah, it's a really interesting question, Tom. We're trying to figure it out as we speak right now. When we look at the spread action between gasoline on the forward curve and inventories, seemingly there is enough oil or enough gasoline in New York Harbor. And New York Harbor, I just want to point out, is important because that is the delivery hub for the mercantiles, diesel and gasoline contracts. Now, when we look at overall supplies relative to demand, we're looking at about 24 days worth of supply of gasoline. That is normal. That is spot on to the 5-year average, and it's slightly above a year ago. The problem now is that traders are skeptical. They are pricing in a premium on the front end of the curve, which is a clear signal that someone out there is concerned about these supplies, regardless of the fact that we do have all this phase worth of supply. The other big issue here is jet fuel. Right now, we don't have enough. Jet fuel stocks are extremely low. And as we look forward to next week, we expect this, or I should say AAA expects this to be one of the busiest travel seasons for Thanksgiving of the past 20-odd years. So when we look at the rising demand, when we look at the spread action, something here is afoot. It doesn't line up that the spreads are saying one thing, i.e. there's not enough supply, regardless of what we're actually seeing in the weekly inventory reports from the EIA.
So, Stephen, the Saudis are frustrated with the price action, as you can imagine. I just wonder if they're frustrated enough to change policy again. Do you think they are?
Yeah, it's really interesting, and it is really conundrum that, to be honest, I am perplexed that the market never really priced in any sort of risk premium with regard to what is happening now in the Middle East. And let's be clear on this. This is a war not between Israel and Hamas, but it is effectively a war between Israel and Iran, given that we're fighting, that is to say, Israel's fighting Hamas, Hezbollah, and the Houthis, all backed by Iran. Now, that is a pretty scary proposition with Iran's ability to halt the flow of oil coming out of the Persian Gulf through the Strait of Hormuz. So, yes, there clearly is a head scratcher here that we have this huge risk on supply, but the market refuses to price that in. Regardless, we're focusing now on the demand picture. And yes, if you're Saudi Arabia, if you're Texas and you are trying to produce and you're looking at this price action, yeah, you are frustrated at this point. But I want to say here, based on our modeling, we're likely at the bottom of the market right now, given the situation around the globe and the imbalance now between supply and demand.
So, Stephen, do you think that the Saudis will wait this out? Or do you think the Saudis will be on the phone to the Russians and any other OPEC Plus member that's willing to participate in another cut in production?
Yeah, I do think that there is a concern that we'll see further cuts. Already, the Saudis, Russia have extended their cuts, voluntary cuts, to the end of the year. But we've seen now in oil prices, unlike the product prices, we've seen an absolute collapse in the front end of the curve. So we've now actually, on the NYMEX, we moved into a situation called contango, meaning that prices for nearer-term delivery are now below that of prices for longer-term delivery. So this is a clear takeaway that right now, from an oil standpoint, fundamentals are extremely weak. And I would suspect that we'll see the chances are going into the quarter, OPEC Plus either extending the cuts or increasing those cuts into the new year.
Stephen Schork, over the arc of Bloomberg surveillance, 20 years, one of the great shocks has been America's success with hydrocarbons. Into the new year, are we energy independent?
No, not at this point. Now, I want to point out that we were energy independent a few years ago. And keeping in mind, energy independence does not mean we do not have to import a BTU from anywhere around the world. We were a fluid trader in the world. We were the dominant crude oil producer in the world, and we were the swing producer, that is. So for all intents and purposes, we were energy independent when it comes to hydrocarbons, and that is just a shout out to how efficient the industry has grown over the past 15 to 20 years. But given current policy right now, no, we're not energy independent. And going into the new year, the big risk is that we are playing a zero-sum game. That is to say that we are taking off dispatchable BTUs, natural gas, nukes, coal, faster than we can replace them with renewables. That's not opinion. That is fact. The regulators are telling the government this is so, and yet the government is still going ahead enforcing these retirements where we don't have enough power. So everyone out there, get used to this and get ready. There's going to be a huge jump in volatility over the next 2 years, a huge jump in pricing for electricity and for other alternative BTUs, because we're quite not ready for the transition that the government is forcing upon the industry.
Stephen, with a big warning. Stephen Short there at the Short Group. Stephen, we'll catch up before year end, no doubt. Amazing to have this conversation about energy independence, Tom. 13.2 million barrels of oil a day produced in this country. As of the latest data out of the Department of Energy, it's amazing.
It's going to be interesting to see. Bloomberg Surveillance HR. John, let's go to it. It's important. Sheffield Wednesday. Keeping Queen's Park's Rangers out of the bottom of said league. And there's a job opening. Job opening, John.
I've said to Mohammed a million times that we should put together a consortium and buy his beloved Queen's Park Rangers.
Ahmad Badia out as chairman.
He's gone.
QPR.
And Mohammed,
can we speak here? Can we make this a job interview? What is the value of the resurgence of QPR?
Huge. They have the best grounds in London, the most intimate grounds, and the potential is great. So I'm with you guys. You go in the lead, and I'm going to follow.
Pharaoh leading on this, let me tell you that.
If anyone out there is listening, perhaps in Saudi Arabia that might have some money that we can
beverage at the Lanesboro on this.
Yeah,
we could have a beverage.
We'll promise some drinks. We'll promise some drinks. Jay Pulowski next hour. Mohammed, I'm pleased to say, is going to stick with us through the next 60 minutes from New York. This is Bloomberg.
Of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but where it's painful for us to see the toll dementia has taken on her. So this is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
I can't really think of a time when there's been quite this much divergence.
Consumers are pushing back on price, and that's why prices are coming down almost across the board.
High interest costs are finally sinking in. I think we've been impatient with the long and variable lags, but they're coming and they're here.
I would be very, very concerned about a deflation scenario in the U.S. for services.
Is growth going to slow down? Yes, I think so.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Attempting to get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow. Together for the next 60 minutes, the next hour, with the brilliant Mohamed Al-Arian. Your equity market right now positive 0.2% on the S&P. The story this week has changed so quickly. At the start of the week, we were talking about disinflationary trends, Tom. Soft landings. End of the week, we're talking about deflation, and maybe even an economic downturn.
Even fractured markets into a fractured world. We'll talk about Dr. Larian's book in a moment, really leading in your interviews you did, John, on that in London. But, you know, we've been doing a lot of side chat here on sports, on Formula One, on soccer. Guess what? There's some huge turmoil into the market. In, November 15th, the year's over. No, it's not. This is going to be eventful to the Fed meeting.
I remember when James Athey of Aberdeen said narrative ping pong, narrative table tennis a number of months ago. Yeah. Mohammed, that's what it's felt like, just week after week, and sometimes day after day, just switching between very, very different views on the next 12 months, sparked by maybe even a small beat or small miss in economic data.
I mean, think about it, John. For the last 15 months, consensus for the biggest and most mature economy has gone from soft landing to hard landing to no landing to crash landing, back to hard landing, soft landing, and now we're talking about deflation. It's very hard to explain to people why it is that we cannot have stability in the most fundamental narrative.
Here's the book cover, the movie coming to Netflix here. We're thinking 3 years out. You'll probably see it Memorial Day 2027. The book cover is Permacrisis. John, you spoke to Gordon Brown, Mohamed Al-Arian, Michael Spence on this. And to me, the major question, John, is how in God's name did we get to where we are? And it's a loaded question besides a pandemic.
So the beauty of this book, despite the title, isn't all doom and gloom. There are some constructive recommendations, Mohammed, about how we get out of this. And it does feel like a perma-crisis. How do we get out of this?
First, by understanding that there are three common causes to these crises. Low growth that's insufficiently inclusive and doesn't take into account the planet. 2 is repeated policy mistakes, and 3 is inadequate global policy coordination. All 3 can be addressed, and it is a hopeful book because we believe that we're on the verge of a productivity surge led by 3 things: technology, and particularly generative AI, life sciences, and the climate transition. So this is going to be an exciting time if we get policies aligned and if there's more global cooperation.
But out of the pandemic, Prime Minister Brown has lived budget deficits. He's lived United Kingdom and European austerity. Now we've got the interest expense and a real rate regime that's normal. How do you handle the fiscal challenges, which many people think is a perma-crisis?
There's only 4 ways to do it. Either you have growth, austerity, financial engineering, or debt rescheduling. Growth is available. Growth is the best response. The other 3 are really problematic. So we do it by focusing on economic growth.
So the headline here, Al-Arian says America's like Greece. We're going to restructure our debt like Greece.
No, Al-Arian said to you earlier that America is the most advanced in the growth transition because they've understood that you've got to evolve your growth model. And the U.S. is way ahead of Europe on this, and China is also lagging.
Are they diminished by austerity? I would love your study of austerity. It's an old world issue. Bring it in, pull it in, be conservative. Are they too austere?
Actually, nobody's austere right now, but what we've learned is you cannot shrink to growth if you've got to shrink consistently. It sounds obvious, but you'd be amazed how many countries get stuck on this austerity track.
This is going to be a big fight in the new year, particularly down in Washington, D.C. If you are just joining us, Mohammed, sitting alongside us for the rest of this hour, I'm pleased to say. Equities on the S&P 500 shaping up as follows. The scores look like this, with positive 0.2% on the S&P. Yields are a little bit lower, down 3 basis points. Earlier on this morning, a break of 440. We're back to about 440.82. Joining us now, I'm pleased to say, Jay Pawlowski, Principal and founder of TPW Advisory. Jay, in your notes, this line jumps out to me. Current conditions are almost tailor-made for a year-end rally. Jay, let's start there. Constructive. Walk us through it.
Yeah, no, John, I think we're in the early stages of a classic year-end rally. And when you think about it, all the factors are lining up. You have seasonality, so November, December, the best 2 months of the year. You have sentiment up until the past week has been very, very bearish. You have positioning where hedge funds are the largest net short position in 5 years. CTAs are offsides. Institutions are underperforming because they're owning cash. And retail sold the most stock last month of any month in the last 2 years. You add to that the technical situation where we've had a tremendous surge in the market, what are called breadth thrusts, and they are typically very, very positive. In addition, you have a number of sectors in markets in regions now recapturing their 200-day moving average. And you have some, like the semiconductor cycle, semis are breaking out to new all-time highs. So very powerful. And we know how the process goes, John, right? Hedge funds, first they cover, then they go long, then the CTAs flip, then the institutions panic, they're underperforming, they have a gate with the calendar year end, they start to chase, and retail joins the show. So yes, very constructive between now and the end of the year.
Do we do that, Jay, with a renewed breadth, or do we do it by a continuation of focus on the Magnificent 20, say?
Well, tech is definitely the leader, and as I said, the semis are breaking out. I think this is very, very important because one of the debates that's going on are we late cycle about to go into a recession, or are we early cycle about to go into a new global growth cycle? I'm in the latter camp. The fact that semis are breaking out to new all-time highs is very, very constructive. So tech leads, but you have other segments like emerging markets, for example, which we are quite keen on. Emerging markets are just recaptured their 200-day moving average. You have the home builders doing well. You have, many parts of the market starting to pick up and sniff out the fact that interest rates are coming down, inflation is coming down, Fed is done, and all that is constructive for the broader swath of the market that's been laboring under the idea that rates are higher for longer.
Jay, I suspect a lot of people watching you would totally agree with your technical analysis, the handoff from one segment of the investors to another. Where they may push back is on the even more bullish call that you're going to hand off from positive technicals to positive fundamentals. So what makes you so sure that the economy will respond to the lower interest rate environment?
Well, I mean, one thing, Mohammed, is what really drives stocks are earnings. And we just came through Q3. And yes, Q3 was better than expected, first year-over-year earnings growth in several quarters. But more importantly to us, because we really believe you have to focus forward in today's markets. And particularly with the narrative ping pong you guys were talking about a few minutes ago, you have to have a view, a vision, a process. And the fact that earnings for next year, 2024, in the U.S. are double-digit, and they have held in even through Q3. In other words, people did not mark down 2024. That's very, very constructive. And look, we just put out our 2024 outlook several weeks ago in October called Surprise, Surprise. And we laid out 4 macro surprises, and I'll just mention 2 here. One is inflation comes down sooner than expected and faster than expected, lower than expected, rather. So big drop, faster than expected. And we got a taste of that in the past week. And the second plays directly to what you folks were just talking about in terms of stability. We believe we're on the cusp of macro stability. We would point out that notwithstanding the narrative ping pong, the VIX is under 15. The MOVE index for treasuries is under 20. So there's a lot going on that we think is very positive, and that the market is starting to sniff out, and that makes us constructive not only through year end, but into 2024.
Jay, typically when you're constructive, you're thinking about the rest of the world. Am I hearing tech in the United States right now?
Yeah, John. I've converted. We did add directly to U.S. tech in our latest model portfolio updates that we did a couple weeks ago. We have been long semis for pretty much the whole year. So that space has been one we've participated in and have benefited in. So yes, we are believers that big tech, the idea was that higher rates would hurt big tech because of the way people value long-term cash flows. The reality of today is that big cap tech are money-making machines, and they are printing money on top of the money they've already printed in terms of interest rates being at this level. So tech is a leader, and I think can sustain that leadership. But the rest of the world also offers a lot of opportunity because they have valuation and earnings growth. U.S. is capped by its valuation. It's going to be earnings driven. The rest of the world, valuation and earnings growth. So we really continue to favor the rest of the world, particularly, as I said, emerging markets.
John, what you just heard there from Mr. Pulaski, I'm going to suggest is a minority opinion. Into this weekend, coming into the end of the year, the holiday season, people can't fathom that tech will extend.
They can be constructive going into year end, but constructive for the whole of next year, I think, is a very different call.
Major outlook analysis.
Jay, before you go, I know you wanted to squeeze in a question for TK. What is it?
Yes, indeed. Tom, our two schools are going to meet on the field of football battle tomorrow. And as a Duke guy, I always have wondered about this. And so you're a perfect guy to ask. What the heck is a Wahoo?
The Wahoo, well, you know, I look at the Wahoo and I say, I got to talk to Shonali Bassick, because Shonali Bassick is the Bucknell wonder. I mean, she's encyclopedic on this. And, you know,
She's a Bucknell grad.
She's a Bucknell grad.
That's a school in Pennsylvania, right?
This is, I think, it's football or basketball. I'm really not sure which, but the Bucknell Bisons taking on the Duke Blue Devils, padding the schedule, Pulaski.
Where do these names come from? Where do these names come from?
It's tradition, John. This is, Mohammed, this is something really difficult. The whole college football thing, the college sports thing, to John, we might as well be in the Pacific Rim.
College football to me is Alabama, LSU,
They're
Georgia.
Professional combines.
Like that's what it is to me.
I'm worried about Cambridge cricket. You know,
that's a real sport,
that's
isn't
a real
it?
sport.
And that's a very relaxing thing, you know.
Yeah.
You can play cricket
I
in the
haven't
summer.
figured it out yet.
You can have a couple of beers watching that, TK. Sit there all day, chill out. Very relaxing.
Beer at a cricket game?
Yeah, in the stands.
Yeah,
Not when you're playing,
It's a British thing,
Not when you're playing, Mohammed. Jay, thank you, buddy. Jay Pulaski there of TPW Advisory. If you are just joining us, equities right now positive by 0.2%. Yields are a little bit lower by 3 basis points. Tom, 440.63 on a 10-year.
Well, the 10 years, the thermometer here, it is the benchmark yield. Mohammed Alarian, which maturity should our audience focus on? The benchmark? Or do you go to 2? Or do you go out to 30? Or my 97-year Austrian?
It depends for what, John. And I should also focus on the shape of
John.
the... Sorry.
I'm Tom.
It's been a long
He's
hour.
new. Come on,
12
let's
minutes.
go. Chart banner.
Mohammed hasn't had to do the PIMCO alarm for a long time.
That's true.
The best part of a decade. Setting that alarm to like 3 a.m. to come on this show.
Yeah,
you forget who people are, Tom.
Yeah,
And
Do
then
that all the
waking up
time.
10 times beforehand because you're worried you're not going to get up at 3 a.m.
And miss the alarm.
And miss
I know
the-
sleep. That's sleep anxiety. You know, I never wake up to my alarm, ever. Always wake up before it. Always. By about 30, 40 minutes.
And you get up?
No, I just sort of lie there, roll around and start reading the news. And often Tom will message me like at 1, 2 a.m.
Telegraph comes out. What's Ambrose Evans Pritchard doing?
Literally 1, 2 a.m. just get the text lighting up the phone about.
But and what's great
the
about this,
nonsense.
Mohammed, in the world, the orbit that we're in, people think Farrell works a 4-hour day. They think I extended. I work a 4.5-hour day.
And how wrong? They are very wrong. Right?
Well, a little
Thanks
bit
for your support, Mohammed. We appreciate that. Mohammed's sticking around, I'm pleased to say. David Lefkowitz of UBS Global Wealth Management joining us in the next hour. Equity futures on the S&P positive by 0.2%. Live from New York City this beautiful Friday morning. Good morning.
Connection lost.
slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
DOJ or other authorities.
Could face bigger challenges.
What's next?
It was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
We gather this week in San Francisco at an inflection point in history. Together, we can harness the power of the Pacific to grow our economies, to uplift our workers, to protect our planet, to connect our people to one another. So much of history of the world will be written in the Asian Pacific in the coming years. We must never forget that it's a history that belongs to all of us.
It's been quite a love fest in the last 48 hours in California. President Biden hosting an APEC dinner, capping off 2 days of meetings with China's Xi Jinping and other foreign delegations. The president leaving San Francisco today to spend time in Delaware over the weekend. Some of the language that came from President Xi, pledging to take heartwarming steps to attract foreign capital, develop a world-class business environment. We mentioned at the start of this week it was likely we would get this charm offensive from the leader of China, Tom. That's exactly what we've had this week for sure.
Watch where people sit at a gathering to the right of the president as he made those comments. Folks on TV, a standard standing at president and the worthy seated was Mr. Lee of Singapore after his interview with our John Micklethwaite at the New Economy Forum. And again, this is about China and the U.S., but in a broad sense, the Pacific Rim as well. Our military, our treaty obligations, the approach of Washington to a Pacific Rim of a new century.
They are all with a big interest in this, Tom. I would say there are two countries that I can think of just straight off the bat that have benefited from this tension between the United States and China. Vietnam being one.
Absolutely.
And I think Singapore, given what's happened with Hong Kong over the last few years.
Yes, absolutely.
Singapore, I think if you wanted to put a headquarters now in Asia, Tom, and you were really thinking about doing it 20 years ago, 10, 15 years ago, most people in finance would say Hong Kong.
Absolutely.
Now I think they'd be saying Singapore.
Even with a long plane flight down. And what's really important is the Bramocam is picking up Alarian, who really, really wants to jump in here. Mohammed, on the Pacific Rim, and to see Mr. Lee sitting to the right of the President of the United States.
So what I think we have to understand is that most countries have what I call a dual option approach. They rely on the US for national security, and they rely on China for economic prosperity. So the last thing they want is to make a choice. So they are very happy to see a rapprochement between the US and China. But we also have to remember that that rapprochement was in the interest of both leaders. Both leaders needed to be seen domestically as doing something that is consistent with their leadership. Xi needed it desperately. So I'm encouraged by what we saw, but I wouldn't get carried away.
Can I name a fence sitter trying to play both sides and have done for a while? Germany. Germany happy with this?
Yes, I think Germany is happy with this. John, no one wants to make that choice between aligning either with China or the US unless they're really forced to. Australia has discovered the cost of not getting it right.
A lot of happy talk this week. Jeanette Lowe-Strategas weighing in on this meeting between Biden and Xi and saying this: the meeting does not change the trajectory of US-Chinese relations. Tom, the US will continue to push for de-risking or decoupling with China in order to protect its national security interests, and China will continue to push to develop a multipolar world against US interests. Jeanette Lowe there.
Join us now from Strategas, Ms. Lowe. Jeanette, I look at where we are, and of course, the major question is, what's the next step? What is the next step? Should we look for President Biden to visit China?
You know, that's probably to somewhat extent unlikely. I think maybe if we look back at last year, we had a meeting between Biden and Xi in November of 2022, and, you know, not much occurred out of that. After that, a couple months later, we had that spy balloon flying over Montana, which then ruptured relations again. So I don't necessarily think that there's going to be a lot more steps moving forward. It was also very interesting to have the defense secretary at the exact same time in the Philippines talking about continued coordination while this APEC and the Biden-Xi summit was happening in San Francisco. So I think this is going to be about trying to lower the temperature, trying to make sure we have continued communications. As you guys have mentioned, having Xi, he wanted to he's having some domestic issues. This is also a good opportunity for him to kind of have a reset. But ultimately, I think that the two sides are going to continue on their trajectories, and this is not going to change the overall path. What it is going to do is just make things a little bit easier in the short term. We have an election coming up in the U.S. We don't want to continue tensions with China. But at the same time, if Biden was to be too conciliatory towards China, we have a whole lot of hawks in Congress who would then pounce him on that.
So, Jeanette, I very much agree with your analysis. Can you take it one step further? How easy is it to de-risk without decoupling?
Right, and I think that this is part of the issue, too. I mean, the U.S. has been trying to make strides to de-risk from China, but it's going to take quite a bit of time. Obviously, we're quite reliant on China for supply chains, for critical minerals, for a whole host of things. And so it's going to be very difficult to actually move those pieces away. And so I think that trend is in place, and you're going to see it continue over the next couple of years. But that also means that to some extent, you almost need a détente at the highest level so that you can build these pieces out from the bottom and ultimately get to that de-risking. I don't think decoupling is probably where the ultimate goal is, but it is really about trying to protect U.S. national security interests and making sure there is reduced dependency on China. And I do think that you are seeing that, you know, regardless of the fact that you have to make choices between how you align with U.S. and China, there is an effort, or there is a realization across the globe that having too much dependency on China is not a good thing either.
And from China's perspective, de-risking involves building little pipes around the U.S. at the core of the system. How far can they go into building basically an alternative global system?
So this is obviously something that they have been working on, and they would like to continue to accelerate that. I think the one thing that is important is I think the fact that the U.S. is not doing this alone is important, that they will actually be more successful in actually trying to at least move supply chains. China's still going to be involved. China's still going to try to, you know, work with their partners in Asia to get around some of those pieces. But the other thing is that if you look at China trying to build this multipolar world, they have been doing that over the course of a couple of years. They're trying to obviously move away from the U.S. dollar. They're trying to get other countries to do the same. But if you are looking at China also being in a place of having economic weakness, that also is not necessarily conducive to them actually being the leader of that movement. So there's a lot of things that have to be worked out on both sides to actually reach their ultimate goal. And I think that's why we're going to kind of see I don't want to use the term muddle through, but kind of a muddle through scenario where they continue down their path. But there is obviously some need to be conciliatory in the interim.
Quickly here, Jeanette, and I've been guilty of this all week. I have failed and taken my eye off Ukraine. Ukraine in this cold December. What will that debate, that study look like?
Right. So this is the U.S. does not have a lot of military aid left to provide to Ukraine at the moment unless Congress appropriates more funding. And so the spring offensive has not necessarily produced the results that both sides were looking for. We're going into the winter, which makes it more difficult for there to be progress on the battlefield. I think that you will see an effort in Congress to try to come back from a Thanksgiving holiday and pass Biden's national security supplemental, which would provide aid for Ukraine, as well as Israel and Taiwan and the border. But that is something that they still are trying to find a solution on. They need to figure out whether or not they can add border policy changes in order to get Republican support for that bill. But if we don't get aid to Ukraine over the next couple of weeks, there is probably going to be a a strong hole put into Ukraine's defenses, because they really do need more money. You obviously have Europe also supporting them, but Europe has been struggling to get some aid packages passed, some munitions given to them as well. So it's been put on the back burner, but I think you might start to see more discussion over it over the next month in Congress at least.
This is the fight we're going to see going into the new year. Jeanette Lowe of Strategas. Jeanette, thank you. Just to go back to China, Mohammed, we talked about the nation states that were sitting on the fence, trying to maintain a relationship in both spheres, China and the US. Can we talk about corporate America, which is trying to take this pragmatic approach, but on the surface often contradictory, please progressive consumer bases, maybe in the United States, but at the same time appease foreign dictatorships? How's that going to go? What do they do?
So it's easier for a country to be a politically swing state, as Jared Cohen of Goldman called it, than for a corporation. If I was sitting in a board right now, I would caution against investing too much into China.
And that's what we've seen over the last year, Tom, which is why you see it in the data. Foreign direct investment.
Oh, no question about it. The data point of the last 6 weeks.
You don't turn that around with some happy talk in San Francisco, California. Maybe that's the start, but it's not the end. No. This is Bloomberg.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
So far, so good in this market. Equities up by 0.2% off the back of 3 days of gains, poised for a third week of gains on the S&P. Longest weekly run since the summer, I believe, going back to July. On the Nasdaq, we're just about positive 0.04%, and the small caps on a Russell absolutely everywhere. I had a note from Torsten Slock just moments ago. Let me pull up the email. On the Russell 2000, before even entering a recession, this is what he had to say, Tom. The share of companies in the Russell 2000 with no earnings is at 40%. 40%. That from Torsten Slock over at Apollo just moments ago.
Really important on profitability. It drives me nuts. And I say this about Apple with all the doom and gloom. I'm dressed like Dan Ives today, so I was going to be careful here. Do you run a company for growth at the top line, or do you run a company for growth down the income statement? And that's a parsing that financial media doesn't do enough.
It's difficult going into next year, that's for sure. They're the numbers right now, and we get an economic downturn. What do the numbers look like in 12 months' time?
I think by, the middle of January, third week of January, I'm going to be able to announce on the show that my theme for 2024 is the sustaining of the Magnificent Seven. I don't have some cute phrase yet, but I think that's really where we're heading.
Saw the same thing over at Goldman.
Redo.
Let's turn to the bond market.
I'll steal it from
2-year,
Goldman.
10-year, 30-year. 10-year right now. Yields lower in a big way from where we were last month. We've gone from 5% to a break of 440 to just above 440 right now. 440.63 on a 10-year. We're down about 2 or 3 basis points. Tons of feedback this morning about our consortium that we're putting together to buy Mohammed's Queen Park Rangers. As they just discussed, I'd happily support the idea of the 3 of us putting together a consortium to take over at Loftus Road.
And what's great is out of Thanksgiving, we can wrap it around, Saturday, November 25th. Is it Norwich or Norwich? Norwich. Norwich is like where the Pilgrims came from, East Anglia and all that, right? And so they're playing QPR at Norwich, and we can go and feel the Pilgrim experience.
Mohammed can get us some tickets. Andrew Ball's over at PIMCO. Norwich is his side.
And he goes, to every game.
Ed Balls used to run the club, right?
Correct. He used to be chairman.
Used to be chairman.
Yeah, there you go. So we can go there and we start a rumor. Henry Winter will pick it up, and
Let's turn to foreign exchange. Checking on the euro. Eurozone inflation final read for October came out. Had a two handle. Came out a little bit earlier. 108.65. We're positive there. 0.1%. Let's get you some company stories under surveillance this morning. Disney CEO Bob Iger planning to address employees in a company-wide town hall after Thanksgiving. A number of senior executives, including the heads of film, TV, and park divisions, are expected to join the discussion. The media giant has been battling activist investors and struggling to adapt to changes in consumer viewing habits as consumers cut the cable cord, Tom, in favor of streaming. It's messy over at Disney, Tom. It feels like things are for sale. ABC, ESPN. I think we all want some clarity on the path forward from here.
Jeffrey Ubben out of Duke, and you're really quite good and skilled at Value Act, and the answer is he's not going to yell and scream, get up on the table and do this, do this. It's going to be a governance mission by these activist shareholders that are stirring the pot and trying to get them forward. What I would suggest is they're getting them forward in a technology that hasn't identified profit yet, with the exception of Netflix.
Should we discuss activist unions? United Auto Workers,
employees
at GM approving a new 4.5-year labour contract, ending a tumultuous months-long bargaining process by a slim margin of votes. The historic deal will see base wages increase 25% over the life of the contract, the return of cost of living adjustments, and the ability to strike over plant closures. Voting is still underway at Ford and Chrysler parent Stellantis, where workers reportedly support the agreements by wider margins than over at General Motors. Mohammed, let's sit on this for a moment. 25%. You and I have been talking about this now for weeks, if not the last few months. Do you look at this situation as the dying embers of a hot labour market, or is this a sign of forward look as to what might be in store for us around the corner?
I think it's the latter, John. I think we are finally seeing labor getting more power relative to capital, and that reverses decades of capital totally dominating. So yes, I think this is an important shift. It does reflect the structure of the labor market, and I suspect you'll see other agreements follow this one.
The labor share here, can the wage gains on a real basis move outside the union debate over into a largely non-union America?
I think they already are doing that, John. We see
Honda, we saw 9%. See, he called me John again. See how he does that? No, it's like we're going for the hat trick.
He's never going to come back.
He's never going to come back.
Never going to come back.
Bill, continue.
I am speechless. I would love to be called John. Are you kidding? It would be the biggest compliment.
It is. It is.
You can call me John anytime you want.
Thank you so much. What a compliment.
On the non-union America, Honda will lift wages 9%, I believe, off the UAW LA.
I've never seen you blush before, Tom.
It's a makeup.
Let's turn to another story, TK. It's okay.
Save us.
IBM. This is a serious story. Announcing the company is suspending its advertising on X, the platform formerly called Twitter, after their ads were spotted by a watchdog group next to pro-Nazi post on the site. It comes a day after Elon Musk endorsed an anti-Semitic post on the service targeting the Anti-Defamation League. The incident prompting outrage from an investor over at Tesla, with the electric car company stock falling by almost 4%. Tom, where to begin with this?
Where to begin with this is a really delicate question with immense respect to the career of Mohammed Al-Arian, who has done well and prospered in business. Do people start thinking differently when they have a lot of money? I mean, Musk here has a ton of money. Like, is he richest guy in the world?
One of.
Something like that?
Sure.
And the question is, do they think differently than we do?
I think they believe that they can control any narrative, and they are surrounded normally by people who simply reinforce that.
On a second-by-second basis.
Yeah.
By a phone call
Tom,
basis.
you've got the business damage that it could do to X. IBM certainly taking a step back. We'll see if others follow. And then you've also got the brand damage you do to Tesla simultaneously at the same time. Never mind the investors. What about being associated with that brand, given that you know that brand is so closely associated with Elon Musk? Those kind of comments, I don't even know where to begin. I don't even know what that's about.
Linda, the chief executive officer here, how does she respond to this professionally and personally as well?
Do you get the feeling that Linda Yaccarino is running that company?
I don't think anybody's running Elon Musk but Elon Musk. I don't think I'm editorializing
I'm
there.
right there with you.
Yeah.
I think a lot of people feel the same way.
I just think it's fascinating, and it speaks to Davos and all that we're going to see there. And the basic idea is the fancy, great, and worthy. They're not running around making Elon Musk comments.
I say this every year we go, Tom. Davos needs to get real.
Yeah.
This establishment nonsense, everyone on the same page.
Everyone on the same page, I think, is
they need
is
some
fair,
real. They
need a real debate.
They talk about diversity there all the time. They need some real diversity of thought at that conference. Which
so if we go and do an hour, we can do an hour there in Formula One racing. It'll be huge. I mean, think of the Toto show up from Austria.
Hey, Toto is just a business guy. You see his reaction to the mess in Las Vegas.
But he's also an academic. I mean, this guy from Mercedes, Mohammed Al-Arian, lectures at Harvard, lectures at fancy schools like Cambridge. I mean, he has a real care about the academics.
He does. He really does.
We'll have to see. Right now, joining us, and I'll decide. Chief Investment Officer, Fixed Income at Franklin Templeton. She has survived 2023. Sonali, you going to clip the coupon like Bill Gross did at the bottom of PIMCO years ago, or can you find total return in fixed income next year?
I think next year is going to be more clipping the coupon. You're getting the income because I don't buy the rate cuts that the market is pricing in. Right now, the markets are priced, I would say, for beyond a perfect landing, right?
Given that, then, what's your call on the bond market now, Chanel? We've had this big correction from 5 down to 450, down to 440, briefly 430s this morning. What's the call now?
It's been too fast. I don't think it's underpinned by fundamentals, and I do think we're probably going to get a reversal. So I think that closer to 5 is a lot closer to where the bond market needs to be. Does it happen in the next week, 2 weeks, or even this year as we rally into year end? Maybe not. But the reality is, if the Fed talked about financial conditions and then unsurprisingly has stopped, because at every level, including what we're hearing in terms of wage agreements at every level, I think there do remain risks to inflation. And while I think the Fed will certainly there's a lot of data supporting the Fed remaining on hold, there isn't enough data supporting the pace of rate cuts next year that the market is pricing in right now. So that's the part which I think is unlikely to materialize.
So now let's get your view on flows, please. A lot of people are waiting for the extension trade. People going from the front end to locking in higher yields for longer. Have yields moved down too quickly for that extension trade, or is the move down actually accelerating the extension trade?
So, I think that right now we continue to see, Mohammed, I think that the speed has been too much. So I still think that there's serious risk to the trade. I don't think this is the real extension trade yet, because there remains a lot of money at the sidelines. So I think it was too fast, and I think that we will see more volatility when you see something like 50, 60 basis points coming as quickly as we have seen it come. It smacks much more of fear of missing out, because it's happening at the same time that we're seeing, for example, high yield rally all the way down to 375. We're seeing yesterday it was a 30% chance of rate cuts beginning already in March. If you need that kind of a narrative to support these types of rates, I don't think that's realistic. So as those rate cuts again start getting priced out, I would expect 10-year yields to start moving up as well. And there is the last piece on flows, which is the fiscal deficit, the fact that over the next 3 months, 6 months, at some stage Japan starts moving, and we're going to see additional support leave the long end of the yield curve. So there are just many reasons not to fear that this is the beginning of that serious rally.
Okay, and when you said this is beyond, well beyond a soft landing, I think was your phrase.
Yeah.
Tell us a little bit, what's the catalyst for changing the dynamics the way you think they will change? What are you waiting for? What would be the catalyst?
Catalyst for not having a soft landing or having a soft landing?
No, for seeing, in your words, reality get back into the bond market.
Right. I think actually the data, in part the data, the Fed has tried to do what it can do in terms of saying that no, rate hikes are not off the table. Certainly the SEPs might play a role, but it's not clear that they're going to actually continue to call for no rate cuts. But the quantity of rate cuts which the market is pricing, I think those start getting priced out. And I genuinely don't think that we're seeing yet. We got a good data point. We did not get a sustained reduction in inflation. We got the move from 9.5 to 4, absolutely. The move from 4 to 2, I don't think comes as quickly and as smoothly as the market is anticipating, particularly in light of some of these wage increases we're seeing and the fact that fiscal policy actually remains quite expansionary. On a cash basis, most of the Inflation Reduction Act's deployment hasn't even happened. So we're going to continue to see support from that going into next year.
So now, appreciate the update. Sonal Designer of Franklin Templeton on this bond market. Maybe getting a little bit too happy with this, Saf, about the prospects of a soft landing. If you are just joining us, equities look like this. Firma, positive by 0.3%. Yields a little bit lower by 3 basis points, 440. The turnaround's been amazing. I want to go back to something we talked about a little bit earlier, guys. We've been conditioned by having big shocks and seeing how the Fed responds to big shocks. I think what's forgotten is some of those surgical cuts that took place back in 2019. Mohammed, this Fed is capable of moving 25, 50, 75 basis points under Chair Powell without going all the way back down to 1, 2% from where we are.
But go back to Mary Daly's FT piece that we talked about earlier today. They are really worried of repeating the mistake of the 70s. They do not want this stop-go process. So I think the hurdle for rate cuts is much higher than what the market thinks it is.
Given the communication we've had then, to put you on the spot, forgive me, the biggest risk right now, is it that they don't go far enough or they go too far? Is it they go too far and stay like this too long?
I think that's the biggest risk right now.
That's what it feels like, Tom.
Are they on
2024.
theory?
That's
I talked to Claire about this at length. He and Gertler inventing the mathematics of all this optionality. Is there an operative theory right now in their new measured approach?
No, if there was, then they wouldn't repeat data dependency, data dependency, data dependency. This is a Fed with very little strategic vision, unfortunately.
Just hold that thought. We're going to talk about that in the next segment. Final segment with Mohammed Al-Arian here in New York City. This was fun, Mohammed. Stick around. We'll do another 5 minutes or so. Equity futures on the S&P positive from New York. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
We think what's more likely is a kind of rocky landing where inflation stays stuck at 3, rates stay high, there's some slowdown, and it's a kind of malaise. It's a single-digit equity environment with a real risk that something breaks and you get into a classic recession. So it's really between that rocky landing and then a kind of a classic recession break that we think is most likely to happen.
That's a new one. Rocky landing, classic recession. Just the range of things over at Federated. Steve Cheverone, the brilliant Steve Cheverone, a little bit earlier on today. Some final thoughts with Mohammed coming right up. Let me get you a thought from Citi this morning, just publishing. Andrew Hollenhorst. Here's the quote. From now until the end of the year, we do not project any data that will disrupt the risk-on Goldilocks narrative, but the reality is less pleasant. Andrew and the team going on to say, rising initial and continuing jobless claims may be an early sign that activity is slowing. They finish with this, Tom, and underlying inflation stuck above 3 will constrain the Fed from acting preemptively to avoid a growth slowdown. That's how they're thinking about 2024.
We're going to dive into this conversation. This is so important with Mohammed Al-Arian of the University of Cambridge and writing so much to help us with our clear thinking on these matters. John, as you mentioned, the next strategic theory and what it looks like, and I would suggest the analogs that we have of the past are hugely faulted, including the analog of Jerome Powell in comparison to Paul Volcker in that time. How do we get rid of our ancient analogs to get to our next strategic theory?
So I think, Tom, the one thing we need to do more of, especially among policymakers, is listen to the corporate earning calls. The reason why they missed the inflation call and got stuck on this notion that it would go away very quickly is because they weren't listening to company after company saying that their costs are going up and they believe they can pass it on because demand is strong. Today, most companies are telling you demand is softening really quickly. We've heard this both at the high end and at the low end, which is really unusual. So you've got to be more forward-looking and stop relying on dated numbers.
Right.
This excessive data dependency is going to get us into another problem.
The great Stephanie Kelton will join us later today, folks. This is so important on the linkage of policy and fiscal into monetary. Have we conflated our monetary and fiscal policy? Alan Greenspan fought that day after day. Is Jerome Powell prosecuting fiscal theory?
No, I don't think so. I think during the era of QE, where the Fed was pursuing QE for a different reason, they enabled larger and larger deficits, and they enabled excessive risk-taking. They enabled all sorts of things, but they didn't want to do that. That was just a unpleasant consequence of something they had to do. So I don't think so. I don't buy this fiscal dominance argument, but I do think that if you look at the fiscal side, you can have a situation where yields stay higher and inflation stays higher despite the fact that the economy is weakening faster than people anticipate.
You've been very critical of this Federal Reserve and the leadership of it. You mentioned just before the commercial break the lack of a strategic theory. You've written about this as well, Mohammed. For those that haven't read those pieces, what do you mean by that? What would you expect to see? How would this Federal Reserve change in the leadership of it in the coming months if they developed a strategic theory?
So look what happened in the last month. Chair Powell came out and said something really encouraging. He said, we are seeing more supply coming into the economy. The market loved that. Why? Because that's the solution to a lot of our problems. If we can enhance the supply side, you get more growth, you reduce inflation. Then the very next speech, he steps away from that. The very next speech, which confuses people. So are we looking at a world in which the supply side is getting more flexible? Are we not looking at a world where the supply side gets more flexible? The Fed has to be more consistent about how it believes the economy is going to evolve. You know, that is what central bankers do. That is what Greenspan did. That is what Bernanke did. That is what Yellen did. They didn't just repeat over and over again, we are data dependent.
They were consistent, though. They were consistently wrong coming out of the pandemic. And arguably they had a strategic theory, but it was the wrong one. Or at least it took a lot longer to play out than they thought it would. Haven't they been burnt by that? And isn't that why they've become so excessively data dependent because of what happened coming out of the pandemic?
It may be. It may be. I can't get into their heads. It may well be that that's the case. But when you're wrong, the answer is step back and try to figure out. We've had failures of communication, analysis, action, supervision, and accountability.
I mean, I look, Mohammed, and I go to Alan Meltzer on this. I've mentioned this many times before, and he would chastise me and say, you have to aggregate statistics. That's what we did in 1947, Leontief and all that. Can we have an aggregate strategic vision now for a Fed, or do we have John Edwards' 2 Americas or 3 Americas where we can't have an aggregate economic vision?
Well, their mandate is such that they have to have an aggregate view.
Yes.
When it comes to distribution issues, which are really important, really important, the amount of inequality in the U.S. today is excessive. That's the fiscal side. So the Fed can have a view, and it needs to be an aggregate view.
I mean, I look at Branko Milanovic with his wonderful book out now on inequality, and the heart of the matter is the inequality that Jerome Powell has to prosecute is just extraordinary. I mean, there's no other way to put it.
And we don't talk about it enough. It's not just a social and political issue. It's also an economic and financial issue.
How do the haves get the trust back of the have-nots?
I think by showing that they care more about inequality. You cannot be a consistently good house in a weakening neighborhood. You've got to take into account the neighborhood. Equality really matters.
Trust is just shattered of the establishment. To reframe your question, Tom, what you're really asking is, how can the people trust the establishment, given what happened with the pandemic, coming out of the pandemic? And Mohammed, we do have an administration that claims they care about all of these things, yet you go through some of the polling, the trust isn't there. The trust in their ability to deliver just isn't there.
And you know, when you look back, we're going to look at this administration as having delivered an amazing number of jobs, at having helped pivot the economy to a new growth model. But it's being judged on inflation. And inflation is really problematic. You know, John, when we all talk about inflation coming down, the public believes that inflation coming down means prices coming down. They don't understand that inflation coming down means that prices are going up at a slower rate. And why they don't understand that? Because they're getting poorer. So the irony is that the Fed's slippages on inflation has significantly undermined the trust that the people have in the administration, even though the administration has largely delivered on what it said it would do.
Don't you think we need to change how we talk about the economy, though? Because the electorate feels what is real, which is ultimately prices in many cases are higher than they were pre-pandemic versus now. And we talk about this month-over-month stuff, this year-over-year stuff, and it doesn't resonate for obvious reasons, because for a lot of people, that's not how it works. When we sit here and we strip out food and energy, I think a lot of people sit at home, Mohammed, and say, well, hang on a second, where am I going to live? How am I going to fuel my home? How am I going to feed myself? These things don't make sense.
Yeah, so a few days ago, I tweeted, we don't say tweeted anymore, I don't know what we say.
We post.
I put on my social media platforms a graph from the Wall Street Journal that showed the absolute level of prices of certain things, food, gasoline, and housing. And just look at that. And that's the reality.
That's Brainer's cumulative, though. Our audience, radio and TV, is thinking cumulative inflation, and the bow ties are going month over month, year over year.
That's what they live in. Mohammed, can I just say this was great?
Well, thank you for having me.
Privilege, a pleasure. No, thank you, sir. Thanks for being with us. 2 hours gone just like that.
Jets,
just like
next
that.
3
No,
weeks.
I was just
Jets.
thank you for not mentioning the Jets.
Jets, they tough schedule. Bills.
Very tough. Very. But the fact that we're 4-5 and the fact that the Patriots are 2-8 is the only thing we should care
You're
about.
far too modest to do this. I remember Mohammed at the start of the season did not want this Rodgers trade at all. Didn't want it. Didn't want it. Jets all got happy about it. Then what happened? He's going to come back, isn't he? Is he going to make it back before the end of the season?
I think he's trying, but most people are telling him don't rush it.
That's amazing.
You know, this just popped into my puny head. I mean, if the Hess family, Emirata Hess, Jets, Green, get it. If the Hess family sells out to Chevron, is this another you could be like some Premier League titan. Mohammed could have QPR and the Jets.
I know for a fact that Woody Johnson watches this program, so maybe Woody can help us.
The Ambassador Johnson.
QPR, forgive me, Ambassador Johnson watches this program. So,
and
Woody,
Ambassador Johnson really cares about the Jets. I can tell you.
Can we get him to care about QPR?
I didn't have time today. We'll do it another time. I want to talk to you about Egypt, which in Robert Kaplan's The Loom of Time is the pivot point.
I look forward to that. And thank you for having me.
Hey, Mohammed, thank you, sir. Appreciate it. Really do. Coming up on the program, we'll catch up with David Lefkowitz of UBS Global Wealth Management on the equity market. Equity's doing nicely this week, heading towards a third week of gains on the S&P 500, following a third day of gains in Thursday's session. Equity futures up by 0.25%. Live from New York this morning. Good morning.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop
until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Fed's done raising rates. I believe that part of the process is complete.
We've been trying to figure out, is the Fed really done? I think that the market's now drawn that conclusion.
This is the kind of softness in the labor market that we have needed. And of course, it takes pressure off the Fed to raise rates again.
In that world in which the Fed is very hesitant to declare victory over inflation, it's hard to imagine rate cuts are forthcoming.
I think the Fed is going to be patient here, but I don't think this is a victory.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bramo refrigerator shopping on a Friday out front of the Black Friday sales. We're looking at equities they lift, but it's in the yield space where John and I are focused this morning. Moments ago, John, the 10-year real yield breaks down to new weakness, 2.11%. Can you imagine a 1.99% inflation-adjusted yield?
TK, the turnaround of this bond market's been amazing. You're talking about real yields. Let's just go to nominal yields through 5%, higher yields in the last month, then lower, much lower yields in the last month. TK, break of 440 this morning. This morning, right now, 441.60. Citi's Andrew Hollenhorst. I think we have to keep going back to this. Let's return to this quote, Tom. We do not project any data that will disrupt the risk-on Goldilocks narrative, at least until the end of the year. Andrew and the team going on to say, but the reality is less pleasant. Initial claims, continuing claims, may be an early sign that activity is slowing. And he goes on to say, and this is really the important line, Tom, underlying inflation stuck above 3% will constrain the Fed from acting preemptively to avoid a growth slowdown. That right there, I think, is the counterpoint to the happy talk around the soft landing, disinflationary story of the week so far.
Okay, I get the assumption of a growth slowdown, and that we will see in the coming data, including up to the December Fed meeting. Look for the Fed decides at that time. But, John, what I find important here is, for example, on this weekend of perfect home viewing, leaves falling, the dappled autumnal leaves of New England, and on down. Think what Central Park looks like from that
Beautiful.
view.
You and I can take a stroll this weekend.
8.03% down to 7.69% on the 30-year bank rate. If we get the presumed disinflation, what do you do with a $699 mortgage? You say, let's go.
We caught up
That's
with
what Hollenhorst is talking about.
this week. He was talking about grease in the wheels. Grease in the wheels. This is why the Fed, Tom. Let's be clear about this. This market, many people in it, a lot of equity bulls that you listen to on this program, they want to declare victory over inflation. It's why the Federal Reserve doesn't want to go there.
Exactly.
Fed officials do not want to prematurely declare victory over inflation. Can you imagine what would happen to markets if they did? Chairman Powell schedules a speech tomorrow. Comes out on a Saturday morning.
He's got to be ex post.
Comes out and says, you know what, it's done. We're done. It's great. We can start cutting rates from here. What do you think happens Monday?
Well, yeah, we saw that this week with the CPI report in 1 minute. John, that described that best, the 11 ratio, Bloomberg Financial Conditions Index, and it screams accommodative. It's 0.26. That's exactly what Chairman Powell doesn't want. But you know what he needs? He needs a data check.
A data check. You want one right now?
I think we should do one right now. Euro yen is, better.
On the S&P, I'll keep it vanilla, Tom. You can go to Euro yen in just a moment. Equities at the moment are positive by 0.26%. I've talked a lot about this 3-day winning streak. Could be 3 weeks of gains on the S&P, up a little more than 2% over the last 3 days. About that on the week at the moment as well. 3 weeks of gains, the longest weekly streak potentially, going back to July. Looking at the bond market, I mentioned where yields are. We're down 2 basis points on a 10-year, 441.60. We've got to talk about crude. Entering bear market territory and all of that bad stuff, Tom. Look, down 20% from where we were in September. TK, I was looking at crude earlier this morning, just like you were. We're down about 8-9% on the month this month. We were down close to 11% last month. We had a conversation at the start of October. Remember London? Went to London together. We had all the bulls talking about triple-digit crude by Halloween, and Rita Sen of Energy Aspects.
Right.
Here we are talking about the 70s and maybe even a break of them.
And what it does to gasoline, which for President Biden and all, even the Republicans, is a very emotional topic. John, totally obscure here on a Friday. We like obscure on a Friday. And we do this because Italy taking on Northern Macedonia here in a fun fest. The Italy-German spread is really showing some quiescence, where if you break down to a constructive spread for Italy, that's again that same idea of a good feeling.
They need that right now because there are some questions about Giorgia Meloni's plans for the deficit over the next couple of years, and maybe even a dispute on the horizon with the European Commission. And Tom, I think we all hope we don't have to play that game again on the periphery, particularly in Italy.
Futures up 13. The VIX under 14, 13.88. David Lefkowitz knows this. Head of U.S. Equities, UBS Global Wealth Management, joins us today. I got a 72-page UBS phone book yesterday with scenarios linking GDP into yield into Standard & Poor's 500. Which scenario do you believe in without upsetting Mark Halfley?
That's an easy question. Our base case, Tom, is that we're going to see moderate gains in the equity market in the coming 12 months. You're referring to the year ahead publication that we just put out. And we're also going to see some nice gains in the bond market with yields falling. So, our main message is that we think there's a good chance that we can have a soft landing. That's really the core of our base case thesis. Economic growth in the U.S. likely will slow down. We know the student loan repayments have restarted. Excess savings is becoming less pronounced, and but we think the soft landing makes sense.
I don't. This is so important because I'm trying to buy my first share this weekend off the triple leveraged all cash. If I look at factor analysis, which of those factors will benefit next year? International versus U.S., value versus growth, and the other 14 factors. Which matters to you?
So our factor that we like the most, really across stocks and bonds, is quality. So we're in a late cycle environment. Right, we have a low unemployment rate, we have an inverted yield curve, and inflation is coming down, but it's still higher than the Fed's target. That's a late cycle environment. For stocks, in our work, that suggests you want to own quality companies. These are companies that have high returns on capital, they have strong balance sheets, they generate consistent and generally less volatile earnings growth. And I think that's the same is true in the bond market. Right, you can go out into investment grade corporates, get a pretty nice absolute return. There's other parts of the bond market that also look pretty interesting. We actually here in the U.S. we actually like high yield against senior loans. So I think there's a whole host of opportunities, but we would clearly focus on quality across the spectrum.
David, can we get your rate cut call? What are you and the team looking for next year?
So we think the Fed is going to be slower in terms of cutting rates than what the market is pricing in. We're penciling in 2, maybe 3. But I think this Fed, especially with the unemployment rate as low as it is, I think this Fed is going to be fairly cautious in terms of getting too aggressive. And just to what you were talking about earlier, Jonathan, I think the last thing Powell wants to see is a huge increase or a substantial loosening in financial conditions, just as they're beginning to get their arms around the inflation, and they still have more to go to get it back to target.
So this is what Tom's been really leaning into, just the real rates argument. That keeps real rates quite elevated. David, how much of a challenge to valuations is that going to be, even as people start to get bulled up on the idea that a cut of nominal rates is bullish for equities?
I think, so, I would say we're not expecting, big gains in the S&P for the coming 12 months. Right, we've got our expectation is that we're going to see, roughly 5% gains, and we've had a very strong rally just in the last 2 or 3 weeks. So I think rates on the real side are going to remain fairly high, and I think what's going to be the more important driver here is going to be the fact that earnings growth should improve a little bit. That should support the market. But again, a lot of the soft landing at this point is largely priced in.
What do you do with cash over the next 12 months? Lighten up cash?
Yeah, Tom, I think there's a lot of opportunities out there in fixed income. I mean, you can go out the risk spectrum without taking too much risk. You can get a nice pickup in yield, in investment grade. You can, and if we get the fall in bond yields that we're expecting, then you get a pretty nice total return. So we have the 10-year going to 3.5 by the end of next year. So wow. that's going to be, cash is going to have a hard time competing with that.
I mean, that's Bramo's not here, but I got to ask a Bramo question right now. If you get a 100 basis point move in the 10-year full faith and credit, that's got to be joy to the world for agencies, MBS, and all the other derivative instruments. Am I right?
Yeah. We also like mortgages as well, MBS. So yeah, I mean, we've been sort of tiptoeing out on the duration curve.
Yeah.
But I think that would make a lot of sense.
Did I do okay there? Was that the edge of Bramo?
That was beautiful, TK. Did you see the headline across the Bloomberg on the Bloomberg dollar index, Tom?
Oh, Mohammed's buying QPR?
Erasing the gains for 2023. The dollar index wiping out the gains for 23, Tom.
Yeah, well, I think, currency is the ultimate litmus paper. And, John, I would just suggest within the broader spectrum, you can't have an international pop without weak dollar. I sort of subscribe to that.
Well, let's get the international call. David, can we finish that? One thing that a lot of people got wrong, and this market's been so punishing and this economy is surprised in different ways. The US economy has been so much better than people thought it would be. And China specifically has been so much worse. Given how we've reset those bars going into 2024, David, what's the international call for next year for you and the team?
Yeah, so I mean, clearly China has been disappointing in terms of economic performance. U.S. has been better, as you said, but I also think at this point that's largely reflected in their shares, right? You've got pretty full valuations in the U.S. You've got very depressed sentiment in certain countries in the emerging market complex. So we actually think that's an opportunity. We think that Chinese growth is going to stabilize, and just given how poor the sentiment is in some of these emerging markets, and especially China, that's an opportunity to us. Very different situation where I think a lot of good news is priced into the U.S. We think U.S. can do okay, but have to be recognizing and cognizant of the high valuations.
Are you convinced by the charm offensive that came from Xi in San Francisco this week? Does that even matter? Is that relevant to your call?
No, that's not a big part of the call. I think it's going to be much more about the domestic policy measures that they are putting in place. I mean, clearly the property market is crucial in here, having some stabilization there. What they're doing on the interest rate side as well. So it's more about domestic politics. Look, I don't know. I think a lot of Western companies are really just fundamentally rethinking their supply chains and things like that. I'm not sure one meeting between two presidents is going to change how they think about diversifying and having some resiliency in their supply chains. That's I think a different story.
We've heard that a lot today already. David, thank you, sir. Good to get your perspective on things, your view going into 2024. David Lefkowitz there of UBS Global Wealth Management. If you're just joining us, welcome. Equities are positive, up nicely. Session highs, positive 0.33%. Bond yields are lower by 3 basis points. The 10-year for 40.43. We talked about this charm offensive from Xi Jinping, pledging heartwarming steps to attract foreign capital, Tom, looking to create a, quote, world-class business environment.
The phrases were, managed, to say the least. But I get the dictator thing, and that was a big flap and all that. But
to me, fair to Chinese officials, Tom, they shook that off.
Okay, but what's the signal he sends? I mean, with the defense secretary in the Philippines looking into 4 base build-out we're doing in the Philippines, forget about trade agreements and all that. I think we're rebuilding out Marcus's nation. Fine, but what's really important here is what is the signal the Chinese send that they get the message the pendulum went too far? I circle back to Hong Kong. Maybe I'm wrong on that. I haven't had a lot of people pick up an agreement with me.
So what you suggested, Tom, and I think it's important, you can signal it from words, with words, but ultimately you need to see action policy to get people to buy it. Tom, some people might ask you, the train's already left the station. That David Lefkowitz's point, these companies are already thinking about moving, and they're doing that. They're re-engineering their supply chains, bringing them closer to home. We've seen so much of that from different companies. But I'm with you. If you really want to prove it, Tom, you want to attract that foreign investment again, it's not words that are going to do it. It'll be action.
It's action. And one of my essays of the year, and I'm sort of lining up the year, was a foreign affairs essay, which does Xi really have control over the cities and the lords of the Chinese cities? And that's a domestic issue that didn't come up in San Francisco.
We need to catch up with Anne-Marie, don't we?
We should.
Who's over in San Francisco. It's on the West Coast in
Squeezing
California.
it into a 6-day trip.
AMH is going to catch up with us next from New York. This is Bloomberg.
City, London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story. Is there the kind of upside?
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
I thought what was very interesting in the meeting is after the meeting, President Xi decided to have a dinner with a bunch of American CEOs who gave him a standing ovation. President Xi is desperate for American investment because he has made a series of economic decisions and political decisions, arresting people where capital is fleeing.
Capital has been fleeing. The outspoken Rahm Emanuel there, the U.S. ambassador to Japan, speaking to Anne-Marie Hordern at the APEC summit in San Francisco. Tom, we said at the start of the week, there are two stories in San Francisco that play out. One, you've got the meeting on the sidelines, as they like to say, between the two leaders, President Biden and President Xi. And then you had this gathering of corporate America and a Chinese leader. And we said repeatedly, because of that one data point and a bunch of other reasons as well, foreign direct investment into China turning negative, we would see a charm offensive from China's Xi Jinping this week, and that's exactly what we've seen. Tom, the words, and we have to separate the words from action because so far it is just words. Let's see if we get a change in policy. Pledging heartwarming steps, talking about creating a world-class business environment. You see those corporations, to Rahm Emanuel's point, Ambassador Emanuel's point, Tom, a standing ovation for the Chinese leader from corporate America. They want to be there. It's just been more difficult to be there over the last couple of years.
Ian Marlowe writing up the Anne-Marie Hordern interview with the former mayor of Chicago. Anne-Marie was busy planning her trip to the Calistoga Food and Wine Festival.
Oh, is that taking place?
She's going out there. It's like 30 wineries up in Napa Valley. And
you've been to Sonoma before?
I've never been there.
Really nice, beautiful part of the country.
I have it on my Apple computer now. I have Sonoma software.
That's
as close as I get. Joining us now, still in San Francisco, prepared for a tough weekend, Anne-Marie Hordern joins us, Bloomberg Washington correspondent. And you know, Rahm Emanuel really can cut to the chase. That's why Republicans and Democrats love him. And the ambassador from Japan in your conversation, Anne-Marie, really cut to the chase. The guy from Beijing was courting corporate officers of capitalistic America standing up APEC at the same time. Discuss that.
Well, Rahm Emanuel, the U.S. ambassador to Japan, also a chief of staff to former President Obama, he's saying that China is desperate for this capital inflow to come back into China. That's the word he used with me, and he talked about this two-screen approach where President Biden left his sit-down with Xi Jinping and went and met with other APAC leaders, while Xi Jinping went and met with chief executive officers who paid money, big bucks, to sit at his table and to try to woo and dine them. Then what we saw the following next day is a written speech. Xi Jinping did not give this speech, he could not attend this other event, but a written speech where he talks about warmer ties and making it easier for businesses and foreign nationals to come and do business with China. So, like as Jonathan said, the proof will be in whether or not there is any action. But, and this is really to Rahm Emanuel's point, he wants to see that action and whether or not he thinks it's a safe place where businesses should go and operate. But Xi Jinping really did try to put on that charm offensive while he was here in San Francisco.
The simplistic mindset is the capitalists of the West will move their labor jobs to China and to the Pacific Rim. That's not good. Does this event that you've been at, does it move the bipartisan distrust in Washington?
I think the bipartisan distrust remains the same when it comes to China. And this was really the last moment Biden could sit down with Xi Jinping. As we head into an election year, we are 1 year away from the 2024 election. The rhetoric is going to get so much hotter. It's why I don't think, part of the reason why I don't think Biden shied away from, as he exited that press conference and took that ad hoc question, he didn't shy away from standing by his previous thoughts that Xi Jinping is a dictator. And I imagine you're going to hear that rhetoric start to amp up. So as the heat was taken out of the relationship this week, we've seen these détentes before and we've seen them derailed. So I think this is really about managing expectations and putting a floor in the relationship so it couldn't get worse. Not necessarily so it doesn't get much better, but so this relationship couldn't get worse.
You said it, I said it, Tom said it. Action's so much more important than words. Let's talk about action. Are we about to see the president go on TikTok? Is that what I read in Axios this morning?
Well, Axios is reporting that campaign is weighing this idea that the campaign should be on TikTok talking about President Joe Biden, because the fact of the matter is that is a really lucrative and easy way to reach young voters. That's where they are getting their news. The big issue this campaign is going to have, if they decide to go on TikTok, is the Republicans are going to go after them incredibly hard. I mean, we saw Vivek Ramaswamy, who called it social fentanyl, joined it for this reason. He says, I want to be able to make sure I'm reaching out to young Americans. But at the same time, you've seen a number of these Republican candidates say that it should be banned immediately. It should not be allowed to be downloaded in the United States.
I think we speak down to the youth of America on this and say, I'm going to call it collegially a purple state like Wisconsin. The People's Republic of Madison is going to show up, Anne-Marie, with the youth vote. Is there any indication the youth vote's going to show up and vote for centrist Biden versus their progressive theories?
Well, what we're seeing in the polling right now, and we just had a poll of these swing states, including Wisconsin, is that this recent conflict between Israel and Hamas, you see overwhelmingly bipartisan. Many people in these swing state voters like what President Biden is doing, standing up for Israel. But when you ask the Gen Z, should he be doing more for Gaza? Overwhelmingly, they say yes. And they think more needs to be done for the Palestinian cause. And a lot of that has been trending on TikTok. This is probably part of the reason why the campaign is starting to weigh that idea of whether or not they should go on TikTok. They have in the past, the administration has in the past, used influencers, sat down with them for interviews because they knew that that content would end up on TikTok. So it's kind of a backdoor way into getting their message through TikTok. Now this is potentially them actually, signing up, having an account, something I know I don't have, I know Tom and John don't have, but actually signing up, having an account, and being able to reach these voters.
Let's wrap things up with a great trip for you, Anne-Marie, and thanks for your hard work over the last few days.
It's been okay.
Can you describe San Francisco for us? Because we've joked about it. We've had serious conversations about the cleanup act that took place under Governor Gavin Newsom. What's it been like there, Anne-Marie? What's it been like for you?
So it's been an incredibly difficult trip logistic-wise because, as you can see, there's all these fences around us, and I actually described it to someone yesterday as Pac-Man because you're stuck in a security zone, even your hotel, and every which way you have to turn to get around. So it feels like a security state in central San Francisco because President Xi Jinping and another number of world leaders are here. When it comes to the cleanup, a lot of the streets have been clean, but I've also seen a lot of messy streets as well. So I don't know. I'm going to go for a little bit of a walk today, and I'll have more to
The
report
question
on
here is,
Monday.
can Anne-Marie get to Gumps? I mean, you should see the fake Christmas trees at Gumps. I mean, they do it all.
What they
out.
like. They're
Gumps
good.
is this fabulous department store in San Francisco, and they've been challenged with all the challenges in San Francisco. But I can just see AMH there picking out a tree a la Faro, except it's got that West Coast Asian feel to it. Like
When
you
I
get at
call you
Gumps.
this weekend, like I always do, sometimes FaceTime. I'll make it a FaceTime this weekend.
Yeah.
And I have that beautiful tree in the background, Tom. And you hear the Christmas music going, see some of those festive candles lit in the background. Isn't that going to make you feel warm and
Yeah,
fuzzy?
I'm looking
Don't you
out.
want a piece of that?
I'm going to be warm. I'm going to look out the window at the truck coming up from the Carolinas going, those suckers are going to buy these,
I know.
these trees. Can I say this? Jargon
seriously.
alert. Gen Z, I have no idea. Gen Z, John, is 1996 to 2010.
Yeah.
I didn't know that.
Yeah.
And we're informing every day here. Well, I wouldn't call it Gen Z. I'd call that Gen tuition.
Well, to that point, wait until they start,
tuition.
the old joke, Tom, wait until they start paying taxes.
Yeah,
We'll see how
Mark
their views change. Anne-Marie, thank you. AMH, appreciate your time. Always do. Great work over the last few days. Next hour on Bloomberg TV, the brilliant Priya Misra of JP Morgan on this bond market, the excellent Lisa Shallard of Morgan Stanley, Max Kettner on Goldilocks of HSBC. Stellar lineup going into the opening bell and coming out the other side. TK, this was wonderful. Loved being with you.
This
was
great.
great.
With Mohammed here, it's great.
It's just special.
I think QPR, they're in London?
They are West London, yeah.
West London, so on the way to Heathrow.
Yes.
On the way to,
if you take a bit of a
Chiswick?
Yeah, yeah. I mean, sort of near Chiswick, yeah.
Near Chiswick, okay.
Loftus Road. We'll make that happen one day, Tom. I've been there before.
Oh, yeah.
It's like one of those close, warm, old school stadiums.
It's like,
it's nice.
like Richmond.
It's nice, just like Richmond. Just like Richmond. From New York City this morning, thank you for choosing Bloomberg. Good morning.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg surveillance on a Friday, quiet Friday, no economic data, not important economic data here. We're going to get to it in a moment with Michael McKee, and a real treat for all of you of Global Wall Street coming up. Professor Kelton, controversial on the state of our fiscal morass. That will be interesting to see, to say the least. So a bond market moving 4.40 on the 10-year yield, and of course always moving off the economic data. Michael McKee here on a booming housing economy.
Well, it's actually pretty good news this morning if you want to see some housing work get picked up. At least housing starts up 1.9% during the month of October to a 1,372,000 annual rate. Building permits rise as well, 1.1% to a 1,487,000 rate. Both of those significantly higher than the prior month. The building permits number was negative 4.4 last month. So it does show that there is some work being done in private construction, in housing construction, and despite interest rates, builders are still putting holes in the ground.
Are they rich men's and rich women's statistics? Are we looking at housing now as only the province of the haves?
Not exactly. I mean, the big market is for first-time home buyers. And so what you're seeing is a lot of the builders cutting back on amenities in the houses, making the houses a little bit smaller so that they can bring down the cost. It's still very expensive for people to buy homes, and obviously home sales have not been extraordinary, but new home sales have been better than existing home sales because there is some inventory, and what we've been seeing is prices sort of flatten out for new home sales as prices are, as builders try to hold the line.
When does the mortgage rate on a nonlinear fashion coming from 8.03, I'll say, into now it's down nicely to 7.69. At what mortgage rate in your head does the animal spirit of housing rekindle?
I've asked a lot of Fed people that, and they don't really know.
We don't know.
This is a kind of a unique situation, but they're hoping maybe you get to something like 3.5%, 4%, which is going to take a lot of Fed funds cutting to get to that point where it might spur people to go back into the markets. There's going to be pent-up demand for housing and people who have to move because they're getting transferred or whatever. So some of the shelter-in-place psychology will go away. It just depends on at what point you can afford it.
One more question before we get to our esteemed guest, Mike. I really want you to participate with Stephanie Kelton. Is next week we get to Michigan, and around all this mumbo jumbo that John and I have talked about this morning, there's this hope that we are not anchored or unanchored. In the Michigan confidence data and the expectation inflation data from there, can you detect if we're unanchored?
We don't seem to be unanchored yet, although the one-year numbers have gone up significantly over the past 2 months, which is a little bit odd because Michigan is usually correlated with gas prices, and gas prices have been going down. There is a theory that perhaps what people are doing is expressing their unhappiness with the old overall level of prices, but it isn't affecting what they are doing when they go to the grocery store. They will have extra money that didn't go into the tank. They can buy more groceries, or they can buy more Christmas presents or whatever.
Mike, I want you to participate here because this is an important conversation. It is without question through the pandemic and literally over the last 5 years, she has had a greater influence on the debate of our American economics than anyone out there. Out of Sacramento, Cambridge, and a tour of duty at the very liberal New School of Social Research. Stephanie Kelton joins us now from Stony Brook University. The book is The Deficit Myth, and the 3 letters are MMT. Professor, honored to have you on Bloomberg Surveillance. Are we unraveled, Stephanie, the worry here of the annual interest expense, the return of a real interest rate? Are we unraveling as we roll into 2024?
No, I mean, the Fed is effectively, in a sense, putting fiscal policy, a big part of the federal government's budget, on autopilot. And it's really tantamount to running, you know, a pretty regressive fiscal stimulus. That's what the rate hikes are actually doing. If we don't like it, Tom, there's a pretty easy way out of it, which is to say, if the rate hikes are pushing up the amount of money the federal government is spending to service the debt, interest expenditure up by hundreds of billions and trillions of dollars over time. Remittances from the Fed to the Treasury have collapsed. All of this is adding to the deficit, which triggers more issuance of treasuries, which puts you in what is essentially just a cycle now of higher rates, higher deficits, higher debt, and it will continue for as long as the Federal Reserve holds in this position.
With the deficit, the debt and the deficit is from the new school Heilbronner and Bernstein classically talked about years ago. But the arch MMT criticism is you're handing monetary decision-making from the acuity and date-driven data dependency of a Fed over to the legislative branch. Can we trust the legislative branch to prosecute MMT given where we are right now?
Well, okay, I'm glad you mentioned Heilbronner. He was a professor of mine when I was there and a really terrifically bright person. Tom, MMT is a description of the monetary system that we have today. It is a floating exchange rate fiat currency. Love it or hate it, it's what we have. MMT describes the monetary system that we have and the mechanics of government finance. It's not a policy proposal. It doesn't propose changing anything. It's describing how things already work. So think about what Congress did with the onset of the pandemic, drafting first the CARES Act, that $2.2 trillion, and then the big omnibus bill, a $900 billion package, and then the Democrats came in and did their $1.9 trillion American Rescue Plan Act. All of that was deficit spending. We didn't give Congress any new permission to do anything. We just described how it all works. And it helps to understand why Congress was able to muster that kind of fiscal firepower when so many economists had previously said that when the next crisis came, we would be unable to act. People like Larry Summers said, because of the Republican tax cuts in 2017, that we would be living on a shoestring for decades to come. Those were his words, that we wouldn't have the ability to spend money because of the deficits, because of the debt. That was wrong. Congress has the power of the purse. MMT recognizes that, and MMT says, listen, this is an extraordinary power they have. They need to use it responsibly, and that means thinking before you move forward with bold spending programs about the inflation risk that's associated with those spending proposals. And that's the piece that was missing. The one thing you didn't mention in my, my tour of going through my education and so forth was the time I spent in the U.S. Senate as the chief economist for the Democrats. And I'll just say very quickly, and I'll stop, that when I was in the Senate, my great frustration was being surrounded by members of the Senate on both the Republican and the Democratic side who were drafting bills, $1 trillion of infrastructure, talking about Medicare for all and all these other things without ever mentioning inflation risk. I couldn't believe it. So MMT would have us do things very differently when it comes to the way we approach the federal budgeting process. It's inflation that you have to watch out for.
Stephanie, it's Mike McKee. If wishes were horses, then beggars would ride. The idea that Congress is going to think about anything before they start passing bills is probably not going to happen. So I'm wondering, after all this, is there a limit in the sense that at some point we aren't going to be able to respond fiscally for one reason or another to some sort of crisis because all the money is going into debt payment instead of going into additional spending, and the way we're set up now, we got to pay those bills.
Okay, so two things I'll say. One, I've been hearing this my entire life. You'll remember that Chairman Volcker had interest rates up pretty high, and meanwhile, Ronald Reagan did 2 massive tax cuts and massively built up the military. So again, if Congress has the will to pass legislation, the votes are there, the money is there. And I'll just say, I don't think it's right to say, actually, that we can't trust Congress to rein it in. Remember, the so-called Inflation Reduction Act was Congress's effort to say, listen, we don't want to continue passing legislation given the inflationary environment. So we want to get revenues up. We want to control costs. We're going to negotiate prescription drug prices. That was all Congress taking, careful steps, I think.
Would you suggest, Stephanie, whether it's a Republican or Democratic 2 houses, that we can have budget responsibility? Do you see displayed budget responsibility in the modern Congress and Senate?
Well, Tom, what I'm saying is that if we were doing things the way I'd like to see them done, instead of handing proposed spending bills to, let's say, the Congressional Budget Office and saying, give me feedback on this legislation I have drafted. Tell me if it's going to increase the deficit. Tell me whether it adds to the debt. I don't think that is the most important feedback. I think it would be much better to have CPO and or other agencies evaluate proposed legislation on the basis of inflation risk, but we don't do it that way.
Right.
So I think that would put us much closer to having a Congress that operates with fiscal responsibility, i.e. inflation risk, at the heart of what it's doing.
Can you and, say, a critic of yours, John Cochrane, the great conservative economist, can you and John Cochrane get on the same page and say we need a Simpson-Bowles redux, where in the initiation of that panel, we actually demand that we get something done?
No. Sorry, but no is the answer to the question. You would have to first convince me that there is some sort of looming crisis that necessitates the formulation of a fiscal commission, and I don't believe that we are facing that kind of crisis. Inflation is coming down. So if you approach things the way I do, which is to say, are we at risk? Is the budget posing an inflation problem? Then let's get at it and let's figure out what adjustments need to be made to ensure that we aren't putting ourselves at risk of entrenched inflation well above the Fed's target. I don't think that's the future we're facing.
Fascinating and controversial. Professor Kelton, thank you so much. Stephanie Kelton, I can't say enough about how refreshing to any and all her book, The Deficit Myth, is. She is at Stony Brook, and you know her from the phrase MMT. Our phrase is to do a data check. Futures up 12, Dow futures up 126. VIX, nicely under 14, 13.89. A stunning statistic. The 10-year yield, 4.43%. The Standard & Poor's up 0.2%. We welcome all of you here, Bloomberg Surveillance, and after that controversy, I could feel the heat come up in the room. I mean, our technical staff was like, Kelton, a debate there. I mean, what a raging debate. And, I tried to be collegial and go to Simpson-Bowles as a political solution to what Pete Peterson and Paul Tsongas, and she said no. I mean, that's the polarity.
I think MMT obviously controversial, but perhaps the most controversial thing she said is that Congress could do the right thing, because to paraphrase, to turn Winston Churchill's saying on its head, Congress tends to do the wrong thing only after trying all the right things, and they end up in the wrong place, which is unfortunate.
In the heart of this, and Blanchard talks about this, many others as well, is I'm going to say, Mike, 3 tranches of stimulus. We actually got a Kelton during the pandemic. and we're watching am I right that we're watching an experiment in MMT in real time?
Well, MMT is hard to pin down, as even Stephanie admitted, but we're certainly watching an experiment in how far you can go with fiscal policy in real time. Yeah. Interesting question is, she said before the Congress does something, they should think about the inflationary impacts. And certainly there were some people who were, Larry Summers one, talking about that. But in general, people didn't understand the inflationary impacts because this was a pandemic situation we'd never had before. So would that work the next time?
Michael McKee here off of Stephanie Kelton. That's what Bloomberg surveillance is all about. There's no question the yield space is front and center off of a magnificent 7 bull market. Coming up, Ira Jersey on bonds. Good morning.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
We still lack one of the 3 anchors. You either need an economic anchor, or a policy anchor, or a technical anchor to the bond market. And we've lost all 3. So these moves are going to continue. The thing that has really impressed me is that nothing has broken. If you had told me a year ago we're going to see this incredible volatility in the most important market in the world, it's the benchmark for so much else, and yet nothing will break, I would have said that's impossible.
El-Arian, inflammatory comments there. What a wonderful effort to be with 2 hours of Mohammed El-Arian this morning. He is with the University of Cambridge in their Queen's College. And of course, years and years, a student on the market. Mike McKee gave us a little hint, publishing next week, I'm told. One of the things, we can't release what it is. It's on a need-to-know basis. Michael McKee here, because nobody loves me. Bramo's gone. Farrow's gone.
I'm very fond of you.
The loyal McKee here to provide perspective.
We've been doing this
huge response. Thank you for the emails, and I should say the hate mails on Stephanie Kelton. Always controversial with more mainline media. Of course, what we're doing here, and this is within the bond market, it's a new School of Social Research half hour with Professor Kelton, and now joining us, someone else with Parchment from the new school. The data check, futures up 10, yields stunning, 4.43%, and he's out with his view to next year. Ira Jersey, interest rate strategist for the new School of Social Research and also Bloomberg Intelligence this morning. Ira, does the debt and the deficit of Heilbronner and Bernstein, the high point of new school economics, does the debt and the deficit intrude or make harder your view for next year in bonds?
It does, because supply matters, right? So that, you know, the basics of economics and markets don't stop because you have, you know, a theory like MMT. So given that we're expecting a $1.7 trillion deficit in the current fiscal year that ends next September, the supply side is somewhat worrying and making it somewhat of a challenge as to where yields might go in various states of the interest rate market and the economy. That being said, you know, with the House view that the economy is going to be much slower next year than it has been on both a real and nominal basis, so inflation coming down and real growth being kind of anemic over the course of the year, we do expect 10-year yields to be 100-ish basis points lower than where they are now.
To cut to the chase and what our audiences want to hear, it's a double-digit IRA jersey. I mean, you mince no words about it. Nobody's clipping a coupon. It's time to make money. What strategy, what duration allows for a 2024 double-digit return?
Yeah, so if you go out, even 5-year notes might even have a close to double-digit return, because if we're correct, then you get a 1% reduction in 5-year Treasury yields at a duration of more or less 5 years. That's a 5% return plus the 4.95% return that you get on clipping the coupon. So you get pretty close to 5%, even being in the belly of the curve. But the farther out you go, that's where you get more bang for your buck. So it really depends on your risk tolerance. However, Tom, as you know, we talk about duration and interest rate risk all the time. You go out to a 30-year bond, if you're wrong, right, if we're wrong, you can lose a lot more money in a 30-year than you can in a 5-year. So that's the risk-reward profile, I think, kind of favors the belly to 10-year sector of the curve as opposed to the 30-year or even the 2-year.
It's like a Chinese wall at an institutional firm, a Wall Street firm. We have a surveillance wall where economics never talks to fixed income. Michael McKee with us to help out with, you know, IRA Jersey.
I talk to IRA Jersey all the time. We have a different kind of relationship there. You mentioned the 30, Ira. I'm just curious, as we go into the week after next week being the holiday, nothing's going to happen, but then we get another round of coupon sales. Do we think we're going to get the same kind of problem with the 30? I'm reading that the Treasury Department certainly doesn't think that there was any ICBC issue that caused the weak auction for 30s last week. Does it recover?
Well, so the auctions we get we get after Thanksgiving are the 2-year, the 5-year, and the 7-year. I think firstly there was a lack of demand for that 30-year bond duration, and I think some people were distracted maybe by what went on with the hack. But I don't think it was you know, people worried about the market structure and actually the functioning of the market that really did in that week 30-year. But remember, the 10-year auction was really good. So I think it's just that people are willing to take risk in the 10-year, and the 30-year, they just, at the time, weren't willing to take risk. Now, that being said, I think 2s, 5s, and 7s, they probably come and go. But at the next round of duration auctions in mid-December will be interesting, because it'll be right before the Fed meeting, number one. And number two, we're going to get, before we get some of those auctions, we're going to get the next CPI plus the next non-farm payroll, the ISM data. So we have a whole slew of data. And I think that, you know, whether or not 10s and 30s get bought or avoided a little bit in December really will determine the pace of that data. So if that data is weak, I think you can wind up having reasonably strong auctions.
Well, you mentioned the data and the market reaction to that. I'm curious as to your reaction to what Mohamed El-Erian said earlier on the show about the market not having an anchor anymore, that we've blown through we've blown through the economic anchor and the policy anchor. Economic anchor and the policy anchor and the fundamental technical anchors. Is that really the case? Is the market really kind of drifting without a guide?
Well, I think that, you know, the idea of having, you know, market anchors, I think part of this is the uncertainty about the future of monetary policy and growth, right? So when you get a lot of uncertainty, you do get heightened volatility in the market. And I think that's one of the things that you saw over the last 2 months or so, basically since the end of July, with the sell-off in treasuries, was an acknowledgement that if we are going to have an anchor, and that anchor is kind of coming unleashed unleashed a little bit, which is what you saw when, Jay Powell and the Federal Reserve decided that, tried to convince the market that they weren't going to cut rates next year. That's when you really saw the sell-off. So I know some people are talking about it being a supply. About 90% of that, we estimate, really came from the shift in monetary policy expectations. So I think the anchor still exists. It's just that anchor maybe needs to find a new catch on the floor of the seabed there.
With price up, yield down, not so much what does cash do, but what does this titanic shift we see from deposits to money market funds do?
Yeah, so that's one of the reasons why T-bill auctions have gone pretty well, and that the Treasury Department's been able to issue a whole lot of T-bills. We have a chart in one of our reports this week. I don't remember which one we published so much this week, but we have a chart showing that just the massive increase in the amount of T-bills outstanding over the past 5 months. Those have been able to be absorbed because of the shift from deposits into money market mutual funds, and so I think that's almost necessary in order to fund the government. Now, the banking sector in aggregate has enough reserves right now, and we have enough money in the reverse repo facility that, another $200, $300 billion of T-bills can come out without too much problem and probably will be absorbed. Much more than that might get a little bit dicey, because I think there is certainly a floor of how many reserves banks need to hold, number one, and then number two, I also think that there's a floor for how much money market mutual funds want to hold at the RRP facility, because it's just easy. It's you're facing the Fed, so the chance of default is nothing, and it's daily liquidity that these money market funds need.
Ira, thank you so much. Ira Jersey with Bloomberg Intelligence on fixed income, and the consensus view here is in 100 beeps-ish. 450 into 350, I'll believe it when I see it. Final thoughts here with Michael McKee, always advantageous. A little bit of data today, a lot of data this week. Seismic change, I guess, is what I saw. How ex post right now is the Fed? To me, maybe they've never been this far to they have to wait for the data. They're massively ex post.
Been a very long time. I mean, they've said we're data dependent for years and years and years.
But now it's with a vengeance.
They really are, because the models don't work in terms of predicting what's going to happen in the future. They think they know what's going on, but they need to be sure. They want to make sure they don't make a mistake.
So what's the path to December, I believe it's 13th, look like, other than I will not have my Christmas shopping started by then?
Well, we'll take a look at the PCE inflation numbers at the end of the month and the spending numbers, and then we get CPI the first day.
Does Jobs Day matter? Come on, you're all right here. Come on.
Jobs Day will matter, but the inflation numbers are really what's driving things now. And if the Fed sees that, unless we get a huge jump or drop in unemployment, it's going to be the inflation numbers. If the Fed sees inflation continuing to go down, they'll hold off. They don't want to, as I said, make a mistake and go too far.
Michael McKee, thank you for joining us here on a new school of social research. Half hour, that's what we do for Manhattan here. Green on the screen, a little bit of red. NASDAQ fractionally south, up, futures up 8. The VIX speaks of the week. The VIX in under 14, and optimistic, a bull market 13.98. On the open with Jonathan Farrow, Priya Misra.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. Your equity market on a 3-day winning streak on the S&P 500. Could make it day 4. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York, coming up, slow down fears sending crude into a bear market. Xi on a charm offensive with corporate America and avoiding a shutdown, setting up a spending showdown. We begin with the big issue, eating away at soft landing dreams.
We're at this inflection point in the midst of this slowdown.
There's some pretty significant headwinds.
Seeing those cracks in the consumer.
Consumers are under increasing pressure.
Their wallet is very much under pressure.
The data we've gotten over the past couple of weeks have been on the softer side.
The data is cooling. The economy's decelerating.
There has been this slide in oil prices.
I don't think you want to take all of the probability weight off of the chance that the Fed has more work to do.
The Fed needs to keep the market on its back foot.
Does face a very tricky balancing act.
A soft landing is incredibly difficult to pull off.
People are going to get nervous about the state of the economy. We still don't know if it's a soft landing or a graded downturn.
The real question is are we going to have a slowdown or a soft landing or a recession?
This is a soft landing year.
Soft landings never last forever.
Let's have that conversation right now. We can round up the trading week with two of the very best. JP Morgan's Priya Misra, Morgan Stanley's Lisa Shallett. Priya, first of all to you, is this a hard landing that for now looks like a soft landing?
Sure, I would argue every hard landing starts out looking like a soft landing. I think what we can say looking at the data right now is that the economy is slowing. But are we slowing to a soft landing or are we slowing into a hard landing? I think the data is not definitive. So far, it looks like we're getting this immaculate disinflation, meaning, inflation is declining closer to the Fed's target. We're not there yet, without a meaningful slowdown in the economy. Our view is that the lags are still very much alive and well. They are just longer lags, and the economy is likely to slow down into a hard landing. But I think that's not the story right now. I think that's for the next 6 months. For those of us that have to think longer term, it is something we're positioned for. But right now, it's about the Fed that's done. We're end of cycle. End of cycles, I would argue, are always very hard, very complex. You get data that doesn't definitively lean one way or the other. But I think adding duration risk here, being extremely careful about what credit risk you're taking, I think this is how we position portfolios right now. Right now, I would say it's a slowdown. It's still too early to say that this is a hard landing right now.
Lisa Shallett, do you agree?
I do. I agree wholeheartedly.
I think that, you know, one of the fundamental things at this point in the cycle that we have to distinguish between, and I think that the markets are having a hard time, is the difference between, you know, what happens at this point with the economy and what happens with corporate earnings. And there seems to be this enthusiasm priced into the market that corporate earnings can prove resilient through a slowing in the economy. And that's, I think, where we have the big disconnect. Our best guess is that, you know, these disinflationary trends that are supposed to inspire the Fed to cut have real implications for corporate earnings and a real deterioration around pricing power and what is possible with regard to margins. And I think that companies are really going to struggle, you know, to potentially make some of the numbers and the expectations that are out there. I think people underestimate how strong the tailwinds in this economy have been. I mean, my goodness, the third quarter, the U.S. put up nominal GDP growth of 8.4%. I mean, if I told you that, and then I told you that corporate profits grew like 4 to 6% in the quarter, you'd say, oh, that's pretty crappy.
Lisa Shaller, I think the one that got me yesterday was Walmart's CEO saying this line, we're still reflecting on it. We may be managing through a period of deflation in the months to come. When you talk about corporate profits, corporate America, is there a part of corporate America, Lisa, that you think is more vulnerable than others?
Look, absolutely. I think that, you know, when you take a step back, any of, you know, these companies that have been, you know, systemically taking price, we've seen it among some of the consumer packaged goods and consumer products. We've seen it among some of the retailers. We've seen it in some of the areas where there were supply constraints. Certainly, you know, automotive being, you know, the poster child for that. I think as we see some of this pricing power coming out of markets, this is going to end up having huge negative operating leverage to company cost bases. And these are tough. And when you talk to company CEOs, as we do, you know, they can talk about the macro economy, and then they always think, well, we're going to be okay. We can hold pricing. And those exceptions to the rules in these kind of business cycles are really hard to pull off.
Walmart sounded cautious, Burberry sounded concerned. If you want to look at economic data, look to claims. This from Citi and Andrew Hoddenhorst this morning caught my eye. From now until the end of the year, we do not project any data that will disrupt the risk on Goldilocks narrative. Priya, this is in line with the kind of thing that you were saying in the last few minutes. He went on to say, the reality is less pleasant. Rising initial and continuing jobless claims may be an early sign that activity is slowing, and underlying inflation stuck above 3% will constrain the Fed from acting preemptively to avoid a growth slowdown. So Priya, let's go forward 6 months. The nature of markets is we can never be happy. So let's go forward 6 months. Where do you think we're going to be in 6 months? How does this data start to change relative to the policy you're expecting?
Sure. So I think the Fed's done in terms of hiking. They're trying this delicate, you know, dance here between trying to keep financial conditions tight enough but not allow them to loosen too much. So I expect them to stay on hold. I think the market's a little bit too optimistic about how quickly the Fed might start to cut rates. I think they're going to want to see that inflation very close to 2% or an unemployment rate significantly higher than their 4% that they are forecasting. But I would argue that the labor market's often a sort of lagging indicator. So even though I expect the unemployment rate to rise, let's say 6 months from now, your question, we're at 4.5% on the unemployment rate. So it's higher than that 4%. It's not really a recession level just yet. And inflation's at 2.5%. I think then it's going to be really uncomfortable for the Fed. I don't think they signal near-term eases. And so I think the market might be too optimistic in terms of how quickly the Fed can respond. I think they're going to want to see that unemployment rate closer to 5% before they cut, which actually makes a hard landing in 25 or late 24 even more likely. So, you know, I think the market's pricing in this sort of immaculate disinflation continuing, the Fed starting to cut rates and getting to neutral by 25. I actually think they'll start much later But then this 350, 375 that the market's pricing in terms of Fed funds rate by early 25, I think that's too high. If we are in a recession, the Fed's cutting to 1%, 2%, that's much lower than where the market's pricing in. So I think there's room for bonds to rally, not the next few months, but as we realize that this Fed is pretty firm, that they've lost some inflation credibility over the last 2 years. So I think they want to make sure they put their inflation genie back in the bottle before they can start to signal cuts. And I think that will mean that they'll have to cut a lot more when they actually start to cut rates.
Let's get back to that Fed speak. Mike McKee, tons of it this week. Heard a lot from a lot of Fed speakers. And Mike, they're basically all saying the same thing, aren't they? They don't want to declare victory just yet.
Don't want to declare victory, and they want to keep their options open, as Lisa was saying. You're old enough, John. You go back all the way to last Tuesday when CPI came out, and everybody said, soft landing. And now look where we are and what we're talking about. Here's what's happening in the economy. You can see the various indicators that we're seeing, and this is what's supposed to be happening. The Fed raised rates. All these things are supposed to be slowing down. The question is, how far do they go? Do they go too far, as Priya thinks they may? And what that leaves is a bunch of questions. Monetary policy still works. That's obvious. We don't know about the lags, how long or how variable at this point, but it still works. The key is going to be how much the economy slows. And we have now fiscal issues riding on the back of all this. But the Fed doesn't know what's going to happen next. They're probably more at sea than they have been in any business cycle I can remember, and they're not telling the market what to expect now. So the market is at sea. So on Tuesday, it's a great day for a soft landing, and on Friday, it's, wow, maybe recession. And you can see it reflected in the futures markets. You go to the middle there, John, the third bar from the left is where the Fed thinks they're going to be at the end of next year at about 4%, or at just under 5%, and then the rest of it is where the market thinks they're going to be. They're a long way away from each other, and it isn't clear what's going to close that gap.
Mike McKee, thank you, sir, and I'm so pleased you said what you said. Lisa Shallett, I can't think of many years, and you've seen many years in this market, we all have, where market regimes and the narrative has switched as much as it has this year. This year has been totally unhinged. We've gone from soft landing, no landing, hard landing, soft landing, all over again. Lisa, when you speak to clients, what is that conversation like? Do they sense that frustration as well? Are you frustrated with just how much things swing from one extreme to the other in the space of a couple of days?
Absolutely. But look, this is, to Priya's point, this is what happens at this point in the cycle. We've been, clear that our lens on this market is that we're still in a bear market. If you look on a 2-year trailing basis, this market, S&P 500 at 4,500, is exactly where it was in the summer of 2021. Yes, have we put in some attempts to rally back to the all-time highs in early 2022. Yes, we've made some attempts, but even today with this monster rally in November, we're still trading below where we were on July 31st. So this is a trader's market. It's not an investor's market. And during traders markets, you just get whipped around, and you have to kind of be amused and laugh it off. That there's a narrative every week based on the latest data point. And so much of this underneath the surface, and it's hard to explain to our clients, is trading and positioning and hedging and shorting and short covering. And it's tough. It is tough to create a through line to what this all means.
Priya, it's been so punishing. We're talking about the equity market there, Priya. Do you see the same thing in the bond market? Just to go back to Tuesday, to see a 20 basis point move, double-digit move across the curve, 2-year out to 30-year, on what? A 10 basis point downside surprise on inflation, Priya, and to project that out as meaningful, really meaningful for the whole yield curve is pretty phenomenal, isn't it?
It is. I mean, it's been such a technical market. I would say from mid-September to the end of October, we sold off 75 basis points on not a whole lot. Slightly better economic data, slightly hawkish Fed speak, and the technicals took over. And now what we're seeing is sort of that entire move being corrected lower. To Lisa's point, I think it's exhausting, it's difficult. But if you take a step back, we might consolidate. I do think we've come really a long way. I think 4% to 450, we kind of stay in that range, in my view, over the next few months as we wait for more data. And if it's clear, to your earlier question, that the slowdown is becoming a hard landing, I think then we break that range. We go much lower in rates. But I would argue people under-own fixed income. Look at $4.5 trillion of money sitting in money market funds. Cash has felt really good. In a soft landing, cash still feels good. If the Fed's not cutting rates, well, then cash is a free option. But as we start contemplating when does the Fed start to cut, how slow is the economy, if the Fed's cutting all the way back down to 2%, that reinvestment risk starts to emerge. So I think adding some duration, looking for opportunities, sometimes everything gets sold, and that's when you can look for opportunities. I think it's time to sort of take a deep breath and do your credit work and do the analysis of the companies that can handle high cost of capital. We haven't lived in a high cost of capital world for the last 20 years. I think we have to get used to it, pick the winners and losers, and sort of take a deep breath and not try and get too whipped around in these moves.
Priya, I want to follow up on one thing you said a little bit earlier, and that was your rate cut call. That once they get going, once they have to confront the hard landing that you and the team anticipate, they'll be cutting back and cutting back aggressively. Priya, what we've seen recently over the last 20 years, and I call that recent in the grand scheme of things of economic history, the Fed has responded to two big shocks in the last 15 years or so. It's had to respond to the great financial crisis and had to cut aggressively back to zero. Had to respond to the pandemic, had to cut aggressively back to zero. Why should we expect an aggressive rate cutting cycle if we're not expecting a massive shock?
So I think, is it a massive cutting cycle if we go from 5% to 2%? I would argue it's 300 basis points. In a sort of normal recession, you look at 91 or 2001, the Fed does tend to cut rates 200 to 300 basis points. So if you get a regular recession without a big shock, that's still an unemployment rate 5.5%. That's significantly higher than what they think NAIRU is. They're going to want to lower those real rates. The other thing that's happening is if the Fed doesn't do anything with rates, which I think they're not going to do for some time, policy rates become more restrictive, because as inflation comes down, those real rates start to rise. And they've been rising. I think it's one of the reasons why those lags are kicking in now, because these real rates have become really restrictive. I think they'll want to take rates at least back down to accommodative levels, and then, or at least to neutral and then accommodative. So, I'm not talking about 0%. I'm not saying they're going to do QE. I think that requires an additional shock. But when cost of capital is high, I think at that point, the economy slows down and you become vulnerable to any shock. And that's what can make the recession deeper. So I think in a recession, they're cutting, but they'd want to make sure that we're in a recession. I think they don't want to be preemptive this time around, because inflation is well north of their target, which is why the longer they wait, and then the lags that we're waiting for now, remember, the first cut may have no impact on the economy. I would argue the first 100 basis points of cuts may have no impact. So which is why, if they're truly data dependent, they're going to have to keep cutting. When they cut, that's late 24, 25, and they'll have to cut more because they'll want to get the economy, back to some sort of normal rather than this rise in the unemployment rate.
Based on the economy over the last year, the last 550 basis points of hikes have had no effect on this economy either. Priya Mitra and Lisa Shallett, stick with us. Let's get to the equity market price action. Equity futures right now positive by 0.2% with some movers going into the open. Here's Abby.
John, let's start out with two stocks that are lagging, then we'll take a look at a big winner. And as for the laggard, the first laggard, Applied Materials declining. They actually put up a great quarter. They beat and they raised, but Reuters is reporting that the company, the semi-cap equipment company, faces a U.S. criminal investigation for allegedly violating export restrictions to China. Investors not liking that. BJ's Wholesale Club similarly put up a good quarter. What's holding the stock back, though, is analysts see the growth for comp sales going forward, the guidance a little bit slower. And then the Gap, well, the biggest gain since 2020 on the Old Navy reboot. Plus, they beat earnings, John, by 210%.
Big push higher. Abby, thank you. Coming up on this program, President Xi on a charm offensive.
President Xi is desperate for American investment because he has made a series of economic decisions and political decisions, arresting people where capital is fleeing.
That conversation up next.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Always on the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
I thought was very interesting in the meeting is after the meeting, President Xi decided to have a dinner with a bunch of American CEOs who gave him a standing ovation. I was with President Biden last night where he had a reception, and there were world leaders from the entire region. A telling sign, the split screen. President Xi is desperate for American investment because he has made a series of economic decisions and political decisions, arresting people where capital is fleeing.
President Xi launching a charm offensive with corporate America, looking to woo U.S. executives back to China with promises of a world-class business environment, saying, quote, we'll take heartwarming measures and improve our policies to make it easier for foreign companies to invest and operate in China. Bloomberg's Anne-Marie joins us for more. Morning, Anne-Marie.
Good morning, John. Well, Xi Jinping certainly on the charm offensive when it comes to the American executives he's been trying to woo while he's still here in San Francisco, and he's wheels up, we should note, today. And when it comes to what Rahm Emanuel had to say to me, this is the U.S. ambassador to Japan, but he's been very critical of China, very much so as well, leading up to this meeting. Even a report, Jonathan, NBC News, that the White House asked him to tone it down, something I asked him about, and he said, don't even try ever asking me to tone anything down. His point, though, is that Xi Jinping is desperate for capital. And, Jonathan, what we've seen over the past 4 years is even the policies of the Chinese Communist Party have not been welcoming to foreign investors. Recently, we saw a massive hit in foreign direct investment. But what really caught my attention is before we got that letter where Xi Jinping is trying to talk about this warm embrace for foreign investors to come back to China, the Commerce Ministry in Beijing talked about how they want to have a campaign to look at some of the discriminative measures that potentially are taking place against foreign investors. But as you noted earlier today, Jonathan, these are just words at this moment. It's all going to be decided in the next year and whether or not there's going to be actions.
Warm words, though. Heartwarming words. Anne-Marie, thank you. Great work in San Francisco. Priya Misra, Lisa Shalit back with us. Priya, this year, you know how it's gone. U.S. expectations were low. We've beaten them easily. China expectations were high. We've certainly seen a downside surprise in the Chinese economy. Priya, with that in mind, what are you expecting next year from international growth?
I'm more concerned about international growth, but I think this idea of U.S. exceptionalism can also fade, meaning that there'll be more, I think, convergence between global growth as well as the U.S. I think the U.S. had longer lags because we have fixed-rate mortgages. You know, I think maybe the environment may be a little too pessimistic around China, so I can see China beating expectations a little bit in terms of growth. But I do think that the U.S. is likely to weaken as well. So, you know, I think we're seeing UK, Europe, Canada, we're seeing countries which had significant, monetary tightening showing that impact. And I think the U.S. will be next. So more convergence, slowing global growth, you know, that's sort of my view for the next year.
Lisa Shalit, are you expecting that convergence as well?
We are. I think, our best guess is that China does manage to do a little bit better next year than this year, and that should have some positive implications for, some of the other countries in EM as well as Europe. But by and large, I think this idea of convergence, this idea that perhaps this era of American exceptionalism, is going to come to an end. And I think we need to remember where relative valuations are around the world. If in fact the Fed does start to cut rates, our relative rate differentials come into play, and I think that that's also when we're going to have to start acknowledging and dealing with these issues of U.S. debt sustainability and whether or not there are term premiums in the Treasury curve and things of that nature. So I don't think it's going to be easy sailing to just take a view that a U.S. biased portfolio is the only one that can deliver returns. I think next year is going to be a year where, you can make some decisions and achieve some diversification because there are opportunities outside the U.S.
Lisa, thank you. Lisa Shallett, Priya Misra, just on spending, big battle coming up next year in Washington, D.C. Coming up, the morning calls, and later, the constructive view from HSBC's Max Kentner.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Through the noise. Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
Away from the open and bow, let's get you some morning calls this morning. Morgan Stanley upgrading analog devices to overweight, expecting the downturn in semiconductors to bottom early next year. Citi upgrading Zoom video to neutral, pointing to easing headwinds and a more balanced risk reward. And finally, Evercore downgrading Airbnb to inline, seeing limited catalysts and a rich valuation. Coming up, stocks heading for a third week of gains, adding nearly $3 trillion in market value this month alone. That conversation up next with HSBC's Max Kentner. Your opening bell just around the corner.
that's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
DOJ or other authorities.
We could face bigger challenges next.
It was going to keep rating World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
25 seconds away from the opening bow this Friday morning. Good morning to you. Your equity market scores, we are totally unchanged on the S&P 500. On the session, at least, over the previous 3 days, 3 days of gains on the S&P, setting us up for a third week of gains on the S&P 500, poised for the longest weekly winning streak going back to July. There's your opening bow. Switch to the board and get to the bond market. What a move this week. 10-year yields on the week down about 20 basis points. On the session, going nowhere. A little bit early this morning, a break of 440. Just think about where we've been. North of 5% in the last month, south of 440 earlier this morning. 443.74 currently. In the FX market, 108.69 on the euro against the dollar, positive here by 0.16%, and crude collapsing, plunging into a bear market over the last couple of months. $74 on WTI, trying to bounce back up by 1.69%. We're about 30 seconds into the session. We're positive here by 0.1% on the S&P, kind of doing nothing. They're going nowhere on the NASDAQ, doing something. This stock right here, the Gap, topping profit forecast and posting a smaller than expected drop in sales. Abby has more. Morning, Abby.
Good morning, John. And as a result, the stock is having its best day since March of 2020 on that initial out of the pandemic drop, FOMO rally. That's the degree of the buying power. Coming into today, the stock had been up 20%. Well, now it's up about on the year. Now it's up about 40%. It has everything to do with that profit. 210% better, 59 cents. Now, comp sales still did decline, but less than expected. The strength at Old Navy offsetting some of the weakness at Athleta and Banana Republic. They also did well in terms of inventories, managing inventories better, and fewer promotions. So a similar story in some ways to Macy's relative to having a higher profit on lower sales, and Target for that matter too. Now, something to point out here, John, is the stock is still down more than 50% from its 2021 peak. Not surprisingly, there's a big short interest on the shares of Gap right now, about 20%. So today's 18% move higher right now, a good bit of that could be a short squeeze.
Abby, thanks for that. The update there on the Gap. Big move higher by 18%. Talked a lot this week about the urge to declare a victory over inflation and the fight against it. And Fed officials really reluctant to do so. I mentioned Mary Daly of the San Francisco Fed speaking to the Financial Times earlier this week. Comments again from Daly right now. Not certain on whether inflation is on a path back to 2%. Must resist the pressure to act quickly when patience is needed. You're going to hear different versions of that over the next few weeks, that's for sure, going into year end. Let's get you one more name. I want to turn to the auto space. Tesla shares rebounding following yesterday's steep declines. Ed Ludlow on top of a very difficult story. Morning, Ed.
Yeah, good morning, Jonathan. So Tesla is down for a second straight day, about 1.5%. Actually, on a weekly basis, Tesla is still on track for a pretty significant gain. What I heard in the market on Thursday with that almost 4% drop is there was downward pressure relating to the post that Elon Musk made on the X platform, X, the platform formerly known as Twitter. In that post, Musk agreed with another user's post that said that Jewish people had a dialectical hatred of white people, and Musk also responded saying, you have said the actual truth. The complicated part you're referring to is the fallout and reaction in the publicly traded Tesla. It's almost impossible to draw a fully causal link between that post and the two-day action we've seen in Tesla shares. The stock also up very significantly year to date, right? And then there's the reaction in the private company X. Excuse me. On Tesla, we saw people like Ross Gerber, who's familiar to our audience on Bloomberg Television, come out and say that he's an asset manager. His clients have come to him and said, you know, they don't agree with this. It impacts their desire to hold Tesla shares and own the vehicles. Bloomberg has reported other investors who have basically responded saying that Musk's action or post has caused them to think again on their reaction. On the X side, we had news that IBM has pulled advertising from the X platform, and so now has the European Commission. What this stems back to, John, and bear with me on this one, an organization called Media Matters had released a report on Thursday saying that ads for IBM, Apple, Oracle, and Comcast were running on the X platform alongside pro-Nazi posts. In response, IBM is a name that acted and pulled advertising from the platform. Finally, John, this morning X have emailed me, an executive at X called Joe Benarock has emailed me saying the following: X has done a sweep of those accounts that Media Matters had found associated with the offensive content. Those accounts will no longer be monetizable. In other words, ads won't show up against those accounts that they did a sweep of. But this is the bit that X is pushing back on. They're telling me that X is not intentionally placing a brand next to this type of content. It is completely based on the user who is trying to view the content. And in this case, they're arguing that the Media Matters researchers, in seeking out those posts that their analysis was built on, the ads are following that user conducting the research. It is not something to do with X's algorithm. Thank you for bearing with me. It is not a straightforward story to tell this Friday. Tesla down 2% and down almost 6% on a two-day basis.
It's difficult. There's so many different layers to this. Ed, I appreciate the update. No doubt you'll be covering it a little bit later with Caroline Hyde on Bloomberg Technology. One more name for you. Also watching shares of Applied Materials recording its biggest drop of the year on a report that it's being probed by the Justice Department for violating export restrictions to China. Katie has this one. Hey, Katie.
Applied Materials, we're talking about the largest U.S. maker of chip-making machinery. It's plunging, like you said, after Reuters reported yesterday that the Justice Department is looking into its dealings with China's Semiconductor Manufacturing International. Now, specifically, the DOJ is looking at here whether Applied Materials sold equipment to the Chinese chip maker without the proper licenses. Like you said, that would violate those export restrictions to China. Now, that revelation, it really overshadowed what had been generally upbeat earnings numbers from Applied Materials. It was a beat and raise quarter for the company, but those numbers and that probe news, it crossed at pretty much the same time yesterday afternoon. You take a look at how investors are digesting that news this morning. Applied Materials currently down almost 6%, was down as much as 8.3%. Could be really interesting to see how this one finishes.
Worst day of the year, potentially. Potentially. Katie, thank you for that. Appreciate it. Let's turn back to retail. Ross Stores reporting sales that beat estimates and boosting its EPS outlook for the year. Simone Foxman has this one. Hey, Simone.
Hey, John, yeah, really solid financial statement for the quarter, and that's what's driving shares to their highest since mid-August 2021. Comp sales up 5%. The expectation was for about 3.1%. Profits for the quarter beat as well, and the company was able to boost its profit outlook for the full year that ends in January, now seeing $5.30 to $5.36 a share, had been $5.15 to $5.26. There were some echoes of what we heard from other retailers this week, especially around its fourth quarter guidance, which a lot of analysts pointed out they thought it was a little bit soft. Company looking for sales, comp sales to rise 1% to 2%, and estimate was higher. But Citi's Paul Lejuez writing that fourth quarter guidance seems conservative, and that actually sets them up to do better than most people are anticipating. He also pointed out, and this was interesting to me, about the consumer. It's really unclear here whether consumers are actually trading down and therefore shopping at Ross stores, or whether we see sort of a moderate income consumer not as hard hit by inflation and therefore they're shopping more. Either way, there's a lot of positivity around this name. Analyst recommendations heavily bullish, as they are on the likes of TJX. We'll hopefully get more color on this overall discount retailer situation when we hear from Burlington next week.
Simone, thank you. Looking forward to that next week. If you want some optimism, here it is from Max Kentner of HSBC, and it says year ahead, look ahead for 2024. We think what's happened so far in November can extend well into next year, but we still receive quite a lot of pushback for our view of a continued Goldilocks scenario. Max, I'm pleased to say, joins us right now. Max, let's start here with a few definitions. What's Goldilocks to you? And then we can get into why you think it's going to extend into next year.
Yeah, thanks for having me, John. I think, look, Goldilocks pretty clearly when we look at the next 2-3 quarters, we're probably still going to see roundabout potential growth and crucially, really, really crucially, expectations, both top-down growth expectations. When we look at GDP expectations for the US, for example, they continue to be around zero. When we look at S&P earnings expectations, in fact, from Q3 to Q4, earnings forecasts now and consensus are saying earnings are going to drop by more than $3, right, from Q3 down to Q4. And even in Q1 next year, earnings are not expected to be even back to the levels where we were now. So even still lower earnings than in Q1. So against the backdrop of really low top-down growth expectations and bottom-up growth expectations, we just need a bit of tiny positive surprises. And you can already be bullish. And all of that, coupled with basically core PCE, going towards 2.5, we've got it around 2.7% core PCE inflation by the second quarter of next year. That should allow more sort of definitive guidance around when rate cuts and under what conditions rate cuts can start. That's a great combination, right? It's as Goldilocks as it can get, slightly above or slightly below potential growth, positive surprises on the earnings, on the growth side, and inflation trending down. It's as Goldilocks as we can imagine.
You know the pushback. You put out a note earlier this week going through various pieces of pushback you've had from clients. I'll give you another one. I'm sure you're used to this. Jobless claims. When do claims get to a level, Max, that you think it starts to matter and you have to change your view?
Yeah, I think, anything below 300,000, no, right? And it also depends, I think, on the speed of the increase, right? And really also the persistence of the increase. Because we've seen, I think, jobless claims quite a few false dawns already, right? Where we've sort of gone from below 200,000 towards 250, then we went back down again, then we went back up again, right? So we've seen a few sort of false flags already, which were mostly driven by some quirks in some states, right, and some sort of idiosyncratic factors in some states. So I wouldn't get overly worried before we at the very least, really hit 300,000. And you mentioned the labor market. So that's a funny thing right now, right? If you want to be really, really bearish, what you do is you just show the change in jobless claims. You show the change in the unemployment rate, right? And suddenly it will look really, really scary. But what people tend to forget is that we come out of levels that have been absurdly low really across a lot of indicators on the economy, whether it's jobless claims like you've asked, or the unemployment rate on more than a 50-year low. If you think about delinquencies, credit card delinquencies, total balance delinquencies, or you look at private household insolvencies, or you look at the private household debt service ratio. All of these things have been at ridiculously low levels in 2020 and 2021, and we're just coming back to sort of the average levels where we were before COVID. So this is not yet really the strains that everyone's looking at.
If I clipped that and played it in FOMC meetings, Max, that right there is the case not to cut interest rates. So Max, with that in mind, let's go to the next pushback that I know you get. It's real rates. Why isn't real rates a threat to this rally that you're anticipating?
Well, the good thing is when we look at the correlation, so the relationship between real rates and equity multiples, what people tend to do is they tend to sort of look at the picture from sort of 2017, 2018 onwards. Why? Because since then, the relationship has been inverse. But what people don't tend to look at it, what happened before? When we look, for example, at 2010 to 2017, the relationship between real rates and multiples has in fact been positive. And whilst, it makes sense that there is an inverse relationship because of the lower discount rate, we can easily also argue the other way around. As long as real rates, if they don't spike anymore, if they sort of stick around at these levels, they're also suggesting and they're reflective of better than expected growth, right? They're also reflective really of perhaps better than expected earnings growth going forward. And that means as earnings cannot then surprise actually positively, we're moving perhaps away from a pure multiple and pure yield and real yield discussion to, hey, the earnings are not as bad as we expected. And suddenly actually also the earnings can support a little bit.
Let's say in the last 5 minutes, you've converted the people who didn't believe, who are stuck in cash, Max. Where are you telling them to put that money now?
I think we're quite far away from the pushback I get from that. I think we're quite a few miles away from that to convert sort of the last bear on this planet. But, I think that's one of the crucial things right now. When we look at sentiment and positioning, right? When we look at that, it's still underweight equities, still underweight high yield. Our shorter term positioning indicators still only neutral. So we're really still a long way off that. Where do you want to put the money now? As long as it's this kind of Goldilocks, you want to buy tech, you want to buy the US, you want to buy consumer discretionary, right? Consumer discretionary, if you strip out Amazon and Tesla, it actually looks pretty cheap, right? On a median basis, or if you exclude those two companies overall, you're almost back to where you were during COVID in 2020 in terms of valuation levels, right? You want to buy high yield, particularly US high yield, because maturities are still pretty low in the next sort of 2-3 quarters. They're only going to start picking up in early 2025. So there's lots of things to buy, really, particularly as sort of around that Goldilocks narrative, high yield, tech, US, consumer discretionary.
You've been constructive, and you've been right to be all year. Max Kantner of HSBC is still constructive, looking for Goldilocks to extend into 2024. Max, appreciate the update. Getting so much pushback, which as far as Max is concerned, ultimately, that tells him that sentiment is still beaten up, even with the gains we've seen so far this week. About 14 minutes into the session, equities pulling back just a touch. We're down 0.1% on the S&P. Coming up, a fourth week of losses, sending crude into a bear market.
To see oil prices down more than 20% from the highs at the time that there's a conflict going on in the Middle East is quite astounding.
That conversation up next.
When you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
World of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power.
Balance of power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
I'm a conservative, but I'm not in a bad mood about it.
Fellow governors. Bad mood about being conservative. That's because you feel like populism has taken control of your party.
And Joe Matthew.
What is it about race that bothers you about the new chairman of the Joint Chiefs?
Our military is becoming so political that we're going to go south when it comes to readiness.
alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg. Context changes everything.
To see oil prices down more than 20% from the highs at the time that there's a conflict going on in the Middle East is quite astounding. We all agree on the effects of lower rates and lower oil prices. However, the cause really matters. And if you see rates come down too rapidly, the market is pricing in a major slowdown, and that's not good for risk assets.
Mohammed Al-Arian weighing in on the rapid declines in crude as oil falls into a bear market, setting the stage for OPEC's upcoming decision next week.
I do think that there is a concern that we'll see further cuts. Already, the Saudis, Russia have extended their cuts, voluntary cuts, to the end of the year. But we've seen now in oil prices, unlike the product prices, we've seen an absolute collapse in the front end of the curve.
Let's get to the team coverage. Katie Graff out here in New York, Will Kennedy in London. Katie, this was not the move we expected.
No, and you do see crude rising a little bit this morning. It's up about 2% to $74 a barrel or so, but that's not enough to arrest a fourth straight week of declines. Oil is down more than 20% or so from September's high, near $94 a barrel, so in that feared bear market territory. And there's a number of different factors that got us here. Some of them are technical. You talk about moving averages breached. There's contango talk in certain spreads, but John, chiefly, this is a supply and demand story. You have supply, or rather demand has been softening. You have supply overwhelming that. Just in the past week or so, you had U.S. inventories showing a sharp increase in stockpiles, which of course trains all eyes on OPEC Plus and what their future plans around output curbs are.
Crude down 8% this month alone. Katie, thank you. And last month down 10.76%. Will Kennedy, let's talk about OPEC. Christian Malik of JP Morgan with this to say in the last couple of days, that he thinks sizable cuts are coming from here, and not just from the Saudis. He thinks they'll socialize them among their OPEC peers. Are you looking for the same thing, Will?
Honestly, I think it's too early to say. Clearly, the price drop, John, means that they're going to have to think policy, and they're going to have to think about a response. I think that the market now fully expects that the Saudis to extend its voluntary cuts for the first 3 months of next year. Whether that's the correct assumption, we will see. Whether they can do more from here, it's an interesting question. Saudi production is already down at 9 million barrels a day. That's very low by historical standards, and they won't want to feel very comfortable going a lot lower than that. If they do decide more is needed, I think you make a fair point that they'll want to find a way to spread that around the group. But you've got the UAE, which on the current agreement is expecting to put about 200,000 barrels more oil into the market in January. So it is not going to be easy to reach that kind of agreement if they decide that they need to do more. And I still think at this stage, that is quite a big if, John. I think this is, right now, quite a hard meeting to read.
Well, what have the Saudis said so far in the last month about this crude move in the other direction? Are they saying it's demand, supply? Do they believe it's something else?
They have fallen back on blaming speculators, which is, what people sometimes do when the market's not going the direction they want them to go. I think the point that they would make is that they don't see the fundamentals reflected in the price. And I think they would point to two things. Demand remains very robust. We've continued to see very good demand growth in China. And we've continued to see that Saudi Arabia is able to get good premiums for selling its oil in China and the rest of Asia, which suggests that the market is still quite healthy on that side. The second thing that they would say is that global inventories have fallen. They've fallen hard. And that we also see quite worryingly low stockpiles in diesel coming into the winter. So it's not a clear picture of plenty of oil around, but supply also remains strong. So that's the equation that they're dealing with.
We're all trying to figure it out. Will, thanks for the update. Will Kennedy there off the desk in London. We're about 22 minutes into the session. Your equity market, a little bit of a snooze compared to the fireworks we had earlier this week. We're unchanged on the S&P 500 with some sector price action. Here's Abby.
Hard to disagree with that assessment, John, with the S&P 500 unchanged. And not a lot happening beneath the surface either. We have slightly more sectors lower, but the decline on the worst sector, staples, down 0.4%. Energy is the best sector on the day, up about 0.8%, as oil does get a little bit of a lift after the recent declines. As for the week, though, it's a different story. As you were talking about earlier, we are looking at a third up week in a row. Most sectors are higher. And what this board tells us, these are the top 4 sectors on the week, John, we're starting to see broader participation in this year's rally out of the Magnificent 7 and mega cap tech. So who knows? Maybe there's legs ahead.
Abby, thank you. Quick update on Amazon. Just a headline crossed on a Bloomberg to eliminate several hundred roles in the Alexa division. Not specifying the exact number of job cuts, going on to say this: maximizing resources and efforts focused on generative AI. The stock is up just a touch. Up next on the program, the calendar into the weekend and a sneak peek of next week as well.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
This is Bloomberg.
26 minutes into the session, just about unchanged on the S&P 500, poised for still a third week of gains. Let's get you a sneak peek of next week and what you need to look for today. Here's your trading diary. President Biden today holding a bilat with the President of Mexico. Tuesday next week, we'll get the FOMC minutes plus NVIDIA earnings. Wednesday, jobless claims, durable goods. Thursday, U.S. markets close for Thanksgiving and markets closing early on Black Friday. From New York, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day and enjoy your weekend. This was the Countdown to the Open. This is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So we get to ride in an Uber with the Uber CEO.
Yeah, that'd be pretty cool.
Come along with me, Emily Chang, as I ask tech leaders of today what makes their businesses future ready for tomorrow.
You're an expert.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. It is Friday. We made it. Coming up, we're going to check in with Chris Campbell. He's a chief strategist at Kroll. He's in the studio. He was trying to make the argument to me that you can be based in New York and Miami. I'm like, please, just you're in New York or you're not. Dryden Pence, he's the CIO at Pence Capital Management. He's going to join us as well, give us his market call. And then Bloomberg healthcare reporter Madison Muller, she's going to talk about some of these weight loss pills. They're the next big thing in a $100 billion market. Everybody's talking about it, even Matt Miller, so we're going to break that down. But first, let's kick things off with Nathan Hager and a Bloomberg Business Flash.
Well, Paul, all month we've been talking about the November rally. On this Friday morning, it looks like it's taken a bit of a breather. We check the markets all day long here on Bloomberg. Right now, the S&P 500 is in the red. Maybe we'll call it in the pink, down 2 points. The Dow is down 8. The NASDAQ is lower by 25 points. That's a drop of 0.1%. But Nadia Lovell, senior U.S. equity strategist at UBS, says there are good technical reasons for this stock rally to continue even into next year.
You have earnings that are set to reaccelerate. We're just wrapping up the third quarter earnings season, and that's going to mark the inflection point with corporate profits flipping back to growth. And inflation is coming down. Economic growth remains intact, even though we do expect it to be at a slower pace. And at some point next year, the Fed is going to cut. So all the ingredients, I think, is coming together to really return to a more normal environment.
And looking at the bond space right now, little bit of declines. The 10-year's down 4/30 seconds. The yield up to 4.45%. The 2-year is close to 4.88. NYMEX crude is really catching a bit after dropping into correction territory. NYMEX is now up 2.1%, trading at $74.41 per barrel. COMEX gold is down about 0.2%, down $3 at $19.8420 per ounce. The euro 1.0871 against the dollar. British pound 1.2421. The yen is at 149.59. That's a Bloomberg Business Flash. Bloomberg Markets is on with Paul Sweeney and apparent short timer Matt Miller.
Nathan Hager, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio. And
I could run out of the studio at any moment.
Well, first of all, Matt has shaved his beard. Thank goodness. It took somebody bigger than me to get him to do it. So anyway, that's gone.
It was.
Finally.
I instantly realized it was a mistake. First of all, my daughter fell into tears. I mean, she collapsed. Just traumatized. And then I saw that I have a really weak chin and jawline. No wonder I had a beard, I looked
Looks
good.
Clean. You look professional now. This is what we're talking about. So anyway, we're here.
I just have a tiny little face on a big fat white ball now.
There you go, folks. If that doesn't get you over to YouTube, I don't know what will. Plus, Bloomberg is now on your dashboard with Apple CarPlay and Android Auto. It gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. How do you get it? Well, first of all, it's free. That's good news. You can get it with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple App Store or on Google Play. Just download the app, connect your phone to the car, and get started. And it's all presented by our sponsored Interactive Broker Studio. Let's see what's happening in the markets here today. We're going to check in with Bloomberg News equities reporter Nora Melinda. Nora, what are you looking at?
So the S&P and the NASDAQ are slightly lower this morning, but we are still on track for our third straight week of gains. Traders are obviously placing bets that the Fed could be done hiking, and we are poised for the longest winning streak since July. But looking into some single stock names, I'm looking at Gap. It's up about 30% and still climbing. For its best day since 2020, it had been up about 21% year to date before today, but now it's soaring more than 50% year to date, and that's all because of its blowout third quarter results. It reported an adjusted earnings of 59 cents per share, which were triple the average analyst estimate. That was achieved by fewer promotions and better managed inventories, but we must remember that Gap does own multiple brands from Old Navy to Athleta to Banana Republic, and it did have some really great results coming from Old Navy.
That's a huge move today for like
massive.
A sleepy retailer. I mean,
massive.
Who buys this stock on this print? I just don't get it. It looks like a tech stock or a biotech stock.
I mean, apparently people are still shopping there, so they're getting some traction. And this is all with the CEO, the new one, Richard Dixon. He is really trying to turn around the company after the reputation of the company was dealing with some turbulence due to management departures and inventory missteps.
Okay. What's the story with AMAT?
AMAT. Okay, so Applied Materials, it's sinking as much as 8.3% today, which is on track for its biggest decline of the year. That's after a report that the company is facing a U.S. criminal investigation for allegedly violating export restrictions to China.
Well, we're getting the pandas back.
I'm excited for the pandas. I cannot lie. I love a good panda. But really, the U.S. Department, it's really looking to see whether the Applied Materials has sold hundreds of millions of dollars of equipment without the proper licensing. And we all know that this is coming down as there has been scrutiny from lawmakers about, bringing chips into China and what all the metrics and all the issues regarding that entail. So analysts still remain positive on AMAT, but, because of its forecasts and results yesterday, but ultimately this news is really weighing heavily on the stock throughout the day.
I will say that our Bloomberg Intelligence senior industry analyst, Masahiro Wakasugi, has written a note on this.
Nice. There you go. Nice.
Thank you. He says Applied Materials may face a modest impact from the China curbs. They could have 5% of their sales disrupted if U.S. authorities saddle it with additional restrictions. 5% seems like significant to me.
But then, it's still, quote, modest.
Yeah.
But, I mean, a lot of analysts...
look, all those retailers have seen 5% sales drops, right?
Mm-hmm. Of course, and most analysts are saying that, it really won't be that bad, and maybe it's just a jump scare for today because of this news, but ultimately they are seeing, upside for the company.
Jump scare.
I know, I like jump scare.
Yeah, I love that, too. What are you, a horror movie fan?
Something like that.
Nice.
Nora, do you stay at Airbnbs?
Okay, occasionally I like to, I like to do an Airbnb sometimes, a resort other times, but, are you all still staying at some Airbnbs?
No, please.
Never?
I do. Four Seasons, Nora, please.
Okay, I love it. We're keeping it high.
Yes, exactly. Come on.
Look, if you're in a place like I'll go to watch the races at COTA outside of Austin, and you could drive in and out. Obviously, there are fantastic places to stay in Austin, but you could also get some like cool and weird Airbnbs out by the track.
For sure.
Yeah, so I think there are a lot of cases in which an Airbnb makes good sense.
Then why did Evercore downgrade the stock today?
I'm saying. So they cut the stock to inline from outperform on limited near-term catalysts. Essentially, they're saying that it's largely a valuation call. The stock is really only slipping about as much as 0.5%, but it's still down ever so slightly. Apparently, actually, Airbnb does have, I think, an additional brand that is a little bit more luxury. So if you're looking for a Four Seasons match, I'm pretty sure they have some options for you.
Okay, I did do one when I went to
thought
Cannes.
you did like Vivo or whatever it's called.
Verbo.
Yeah.
When we go skiing out west, but I don't take care of that. I have people who do that. And when I went to Cannes in the south of France, I did an Airbnb, but that was done through Bloomberg, and it was awesome.
Did you have a pool?
No, but I actually had a very cool flat in little side street in Cannes. I could walk down to the water, walk to all the meetings. Very cool.
Oh, wow.
So Bloomberg hooked me up there. So, Nora, thanks so much for joining us. Nora Melinda, she covers all the equities for Bloomberg News. All right, what do we do with this market here? I mean, I kind of feel like if you're telling me I'm at peak rates, I've seen peak rates, don't I just go long the market? I mean, it just seems...
it depends on so many other factors,
No,
right? What valuations?
I just fight. You don't fight the tape. Chris Campbell joins us. He's a chief strategist at Kroll. He joins us here in our Bloomberg Interactive Broker Studio. Chris, what are you telling clients here these days? I mean, we've had this, rally here in November, and I guess it's in part due to, I guess a lot of investors are probably like me saying, boy, if I'm at peak rates, don't I take on some risks here with my portfolio?
Yeah, look, I think it's highly likely that we've probably seen the top of the rate interest rate raise. But I kind of consider myself more of a pessimistic optimist right now, which means I think we're going to go some difficult times. But on the other side of this is going to be quite significant. There's trillions of dollars out there in the park in the sidelines with the funds and families that we advise. And I think they're looking for this correction. I think that on the opposite side of the correction, there'll be just an enormous amount of money flooding the capital market, flooding the markets, and merger acquisitions, and lots of other things that are goodness that will happen. I think probably late next year or early the year after.
Remember, Paul, you want to buy low.
Yes.
To sell high.
No, you just buy them and hold them. Basically.
You like to buy high and hold.
I just buy them. I buy the Mo. Buy the momentum.
Well, I mean, you could get on the wrong side of that trade.
I've been crushed so many times trying to catch the falling knife.
That's a good point. What do you think about that?
It's probably a good idea to buy low, sell high. Typically, it's good. It's good advice.
I mean, you could have caught the falling knife with treasuries at 5%. We were like freaking out. In this studio, right?
That's a good point. I mean, right across the curve, we had fives everywhere.
At $72 on a barrel of oil, and we were freaking out.
I had to buy some oil here now that I think, but I mean, Lisa Bromwich is sitting with a big barrel of oil in her apartment in
she got it for negative $40.
Negative $40. All right, so where in the market are you looking these days here? I mean, because it seems like, do I stick with the Magnificent Seven that have worked so well? Do I try to find some of the laggards? How are you thinking about it?
I think actually you can start diversifying it. Again, if we're seeing peak rates, I do think we're going to be higher for longer. I think the Federal Reserve is going to try to avoid becoming lowering interest rates next year. I'm a little bit of a contrarian in this regard, because I believe that there's it just becomes really political. The Federal Reserve, I think that the chairman actually has an enormous and outsized influence in the 2024 elections, because I think it's mostly going to be the economy, and so I could think that he'll just be very careful and very cautious about that, and so I think that we're in for a tight probably all of next year. I think this is the time to long the market, absolutely, and diversify.
You were, by the way, a former assistant secretary for the U.S. Treasury Department. You have interacted with Jerome Powell on a wide variety of topics, but I wonder what your thoughts are on the Druckenmiller-Yellen spat. I mean, could we really have sold much longer maturities at much lower rates? Should we have done that?
I think there's, as in every argument, there's two sides of it.
Of course, and also hindsight is 20/20. I get that fully.
So, like, I try not to look back at my former colleagues and try to second guess what they've did. It's very difficult. Those jobs are extremely difficult, and they're very hard to So you get pressure from everywhere.
All right, so let me ask you this: in terms of the Fed, for a while there was this thought that Jerome Powell would do anything not to become another Arthur Burns. That is, he wanted to really crush inflation and stop it in its tracks so that it never reared its ugly head again, or at least, during his time. Is that still the case, or is he going to start worrying about, joblessness, an economic slowdown? Is he going to start getting a little bit soft and dovish when the bad data comes out?
Yeah, I always compared him. I think you try to avoid becoming Paul Volcker. I mean, I think he just doesn't want to have, any kind of stagflation. I think he's trying to avoid that at all. So I think that tight for longer, make sure you stamp it out, right? I think that there's, as some Fed governors are suggesting, and I think that the Fed is looking for a slowdown in job growth, and that's all of that means. I think this is where I'm a little bit pessimistic, if you will, and I think we're going to see a bit of a downside. Is that the American consumer is kind of running out of steam. I think that they're the largest economic engine of the economy, and they've spent through their savings, and now they're spending on credit cards at record rates at a very high interest.
So you're also former staff director, the Senate Finance Committee at the United States Senate. What did you do there?
The committee is in charge of all Medicare, Medicaid, Social Security, tax policy, international trade. So it oversaw 70% of U.S. spending and 100% of incoming revenue.
So is it your job to make sure that when senators are on television questioning witnesses and whenever anybody comes in front of their committee, that they sound intelligent?
That, working very closely with the members and their staff, it was trying to set an agenda that was very difficult. The difficult things about what we our mandate was that all of them are extremely political. I can think that good people can have arguments about entitlements, Medicare, Medicaid, and Social Security, but the challenge is trying to actually have a public debate that actually doesn't become highly politicized and really scare Americans is really hard on those issues. And then tax policy, of course, there's always a give and take, where one side typically likes lower taxes, one side likes higher taxes, and it's just you try to find some way to get compromise. But
how much work between senators happens behind the doors? I mean, did they really walk down to the hall and say, let's debate this issue? Does that happen?
Lately, they just say, do you want to fight?
Exactly. and I guess the reason I was going to, because I just, we look at these committee hearings, whether it's technology people coming in front of them or whatever, and our senators and our congressmen, they just sound so uninformed. It's really painful / embarrassing. But I'm just wondering, do they debate the issues amongst themselves?
They do, and staff does a lot of that work for them as well. But I think it's it's very difficult, as they're also pulled everywhere. But the challenge is, and I don't want to get anyone in trouble, because right now in American politics, if you're a Republican talking to a Democrat, Republican talking to a Republican, your voters don't like you. But I will say that there's an enormous amount of that happening behind closed doors, and it has to, because honestly, genuinely, nothing would get done. And I'll tell you,
I think
nothing's getting done now.
The staff people we talk to are always so bright, so well educated. They know the issues. And then when you see these men and women on TV, they're just the worst.
They have to be.
But what happened?
To get elected by the American people.
Exactly. What happened? Don't the staff spoon feed them what to say, what questions to ask? How do they come across so badly?
I'll say that I think that the Congress reflects the mood of the American people at that time. Right?
Yeah, so, I guess that's it.
So I think that's I think that the American people get the House representatives they want and the Senate they want at the time, and of course we have a little bit of a longer fuse on the presidency, right? So, but yeah, I think it's going to be interesting to see how this next election happens. I think there's there's a lot of variables at play, and there's significant issues.
Do you opine on potential election outcomes for your clients?
Everyone wants to know, right? And 'cause it matters. I mean,
right?
The policy under a Republican or Democratic administration is going to change, and of course then it matters if it's Trump or Haley or someone else in the Republican side, and or if it's Biden or another Democrat on the Democratic side. And so, yeah, absolutely. I think that there's significant issues, but I believe though that if the economy is such a central component of the election in 2024, and we are in a downturn, likely it's a bad time to be an incumbent in D.C. at that time, and so I'd likely see a wholesale change. I think the House may go Democrat, the House Senate may go Republican, and we perhaps may see a Republican.
Having gone to the Thunderbird School of Global Management, do you have any advice for Duke on how to play basketball?
I have friends everywhere, so I'm just going to sit on my hands on that.
Exactly. Smart. He'll talk politics, but he won't talk.
I wonder, ASU more fun or UCSB?
Oh gosh, that's a really good question.
Santa Barbara,
well, that's where I went to undergrad. I think
awesome.
it's you're not very far from the beach anywhere on that campus. So it's.
All right, Chris. Thanks so much for joining us, Chris Campbell. He's a chief strategist at Kroll. Talks about this market and politics. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Gap has followed in the footsteps of Macy's and Target, posting a higher profit but lower sales. We have more from Bloomberg's Abigail Doolittle.
It has everything to do with that profit. 210% better, 59 cents. Now, comp sales still did decline, but less than expected. The strength at Old Navy offsetting some of the weakness at Athleta and Banana Republic. They also did well in terms of inventories, managing inventories better, and fewer promotions.
And shares right now, they are skyrocketing. They're up about 30%. And Ross Stores reported sales that beat estimates and boosted its EPS outlook for the year. Bloomberg's Simone Foxman has the numbers.
Comp sales up 5%. The expectation was for about 3.1%. Profits for the quarter beat as well, and the company was able to boost its profit outlook for the full year that ends in January, now seeing $5.30 to $5.36 a share, had been $5.15 to $5.26. There were some echoes of what we heard from other retailers this week, especially around its fourth quarter guidance, which a lot of analysts pointed out they thought it was a little bit soft.
Shares of Ross right now, they are up about 8%. And shares of BJ Wholesale Club, well, they're lower. They're down about 3.5%, even as third quarter earnings beat Wall Street expectations. The focus shifted to the retailer's updated full-year guidance, which reflects lower comp sales growth and also shifts in consumer behavior. Now, one analyst wrote that it's encouraging membership and profit results, but the markets will focus on softer sales view near term. I'm Lisa Mateo. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
We're coming up to 10:22 on Wall Street. I'm Nathan Hager. It's Friday morning, and traders are trying to find a little bit of direction for this market. We check the markets for you all day long on Bloomberg, and right now the S&P is little change, down a single solitary point. The Dow is down 16 points. The NASDAQ is lower by 20. 10-year Treasury's down 6/30 seconds. Yield 4.46%. The yield on the 2-year is at 4.89%. Let's see, 7 of the 11 main industry groups on the S&P 500 are in the green right now, led higher by energy and financials. And look at NYMEX crude right now. It's up 2.4%, up $1.75. $74.65 for a barrel of West Texas Intermediate oil. COMEX gold is down 0.1%, down $2.90, $19.8420 per ounce. The euro 1.0877 against the dollar. The yen 149.62. Why not? Let's check Bitcoin. Up 0.3%. 36,000 is the Bitcoin level. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Matt Miller.
All right, very good. Nathan Hager, thank you so much for joining us. Let's get right to our next guest. There's a lot we can do here. The next guest, I mean, people are coming into the studio today. It's a Friday. There's no Bloomberg people here, but we have 2 guests in a row. And this guy...
Well, 2 of probably the most responsible guests that we have had, certainly all week,
Exactly.
right? I mean, Chris worked for Treasury, and he did...
Real job, real guy.
He was the one who was doing real work for the politicians who just put on the show,
I don't know what happens there.
And our next guest, has a Bronze Star Army Commendation Medal, a V for Valor.
I don't have that.
The Knowlton Award.
I don't have that.
3 meritorious service medals from the U.S. Africa Command.
And then I think he manages some money on the side. Dryden Pence joins us. He's the CIO of Pence Capital Management. He joins us live here in our Bloomberg Interactive Broker Studio, and he's based where again?
Newport Beach, California.
Newport Beach, California.
But he has earned that, and we should thank you for your service.
Absolutely,
truly.
but that could fall off into the ocean, as far as I'm concerned. It's
Well,
too nice out
you
there.
know,
It's
thank
too
you
nice.
for paying your taxes.
Yes.
You know, people don't do that enough, and I always try when someone thanks us for our service. I always say thank you for paying your taxes because the American citizen buys body armor. That keeps soldiers safe when they're out doing the nation's business. And I think people underestimate that. So when you sign that check, and sometimes nobody likes that, just remember, everybody out there, you're buying body armor.
The problem I have with that the taxes is that now more of my tax dollars are going to service debt than to fund the military. And we should say funding the military, in my opinion, should do more than buy body armor. It should also help them find housing and jobs and feel welcome when they come back. And that's I think, one place where we really dropped the ball.
Well, welcome when they come back is certainly, and supporting the families is certainly a very, very important issue. I don't think people understand, particularly when we have these cycles of wars on and on and on again, right? You know, how the effect that it has on families and why it's important when someone comes home that really the community embraces these people because they're out doing the nation's business. I mean, your currency, we can go on forever about this, but in the end, the final analysis, your currency is only as good as your military. And because you got to have an enforcement mechanism. And it says, legal tender for all debts, public and private on that. So, next time you spend $1, thank a soldier.
And Dryden, you have on your lapel, for those seeing on YouTube, I guess accommodation. What is that?
That's a Bronze Star.
That's the Bronze Star.
Bronze Star.
Can you describe why you?
That was
Bronze Star?
I was the psychological warfare officer for 1st Armored Division during Desert Storm.
Okay.
So all the leaflets and loudspeakers and all those things that if you remember the Iraqi army surrendering, that was our campaign, and I was far forward on the ground with that. And so that's sometimes Bronze Stars and things for valor you get for being in the wrong darn place at the wrong darn time.
How dangerous is the world today? I mean, when you see what's happening in Israel, what's happening in Ukraine, and the alliances that are being made among our enemies, how dangerous is it?
I think it's probably more dangerous now than it's been in a long time. And part of this is a threat from what we call asymmetric warfare. You have, small groups of people can create a tremendous amount of chaos and force a great deal of damage. I mean, if you take a look at just what happened in Israel in the Gaza conflict, you have these circumstances where the rockets that are being fired by Hamas, they cost about $800 a piece. Iron Dome is $50,000 a round. And you have these tremendous, while it's asymmetric, in other words, the sides are not balanced in their ability to fight. It's not a conventional type war. But you have this situation where civilians on both sides are trapped between these two warring factions. You see it in Ukraine, Russia. You see it there, and I think the world is a little less safe than it used to be, because you can have these regional flare-ups become quite devastating. But from a market standpoint, I get this question a lot. As long as the circumstance in Israel it doesn't become a wider thing, generally it's not a market devastating moment. If you go back to the last 13 conflicts that we've had, there's about a 45-day round trip, about 14 days down to the market and about 26, 27 days back. So from a market standpoint, it's just creates some volatility. From a human standpoint,
right?
It's quite tragic.
So how do you? What's your view of these markets here today? Because you have to take into Federal Reserve.
Oil. It kind of has made the round trip that you've just described, right? Because we initially saw a big pop, obviously, when there is a hot war in the Middle East. That gets people's attention in the oil markets, but yesterday we hit $72 a barrel.
Right, and what's interesting, this is not 1974, right? So people were extrapolating, oh my gosh, we shut down the Straits of Hormuz, or you had the tanker wars that we had back in the 80s, and the world's not the same. The United States is the largest producer of oil now.
Yeah.
Right? We need about 20 million barrels a day. We produce 12. We get the rest of it from other places. Most of it comes from Canada. We only get about 11% out of Saudi Arabia and Iraq. So if this wider conflict really affected global oil supply, the United States is not going to be nearly as affected as we were in the past. And it's going to hurt India and China and Europe a bit, but not quite the United States as much. The other thing is that this flexibility that we have, but Iran's one of the warring factions, if you will, right? And they need to produce a lot of oil to be able to fund their mischief.
Yep.
And so you have the parties to conflict needing the cash to continue the conflict. Same thing with Russia, right? Russia's got a war going on. So this is one reason why you don't see this constriction in oil prices. Two of the big players have got to make a lot of money to fund their wars. So, it's a fungible global commodity.
So, how does this? It seems like maybe on a geopolitical front, another big thing was just a couple days ago in San Francisco, just getting President Biden and President Xi together. That maybe takes down the risk of the world geopolitical a little bit, and that might be a good thing, hopefully.
I think it does. I think it does. And one of the things, I mentioned this asymmetric warfare situation. I think China had to pay really close attention to a Harpoon missile that cost $1.3 million, taking out a $3.2 billion Russian capital ship.
Yep.
So if they were going to try to take on Taiwan, they could do it, but it would be massively expensive.
Yep.
It would be massively expensive. And you also see the thing in Ukraine, a Javelin missile that,